right, good morning.
Good morning.
Anyone here not taken this class before? Okay, most of you have not taken it, okay. I think most of you know who I am. Just on a personal note, today is my 33rd anniversary in real estate. Started 33 years ago, November 16th, 1989.
Here's to 33 more years.
Yeah, right. I'll take 33 more years. Start out, just so you kind of know my background, I know most of you know that I'm an attorney. When I was in law school, I took several tax classes, and I almost stayed in law school one more year to become a tax attorney, a business and tax attorney. But not having an accounting degree, I chose not to go that route. So I've always had an interest in taxes, and I know a little bit more about it than the average attorney, having taken so many tax classes. And I've always tried to stay on top of it, especially after I got into real estate, because so much of what we do relates has taxes and relates to it. The one thing I want to make sure you know is that my goal here is not to make you a tax expert, or not to give you information so that you can give tax advice, because there's specifically states in the contract that we as agents cannot give legal advice to our clients. We can't give tax advice. The goal here, there are certain aspects, however, that we are expected to know, and property taxes, for example, is one. But my primary goal is not only to make you knowledgeable of those taxes that we are expected to know as real estate agents, but to make you aware of all of the tax ramifications that are out there, so that you can recognize potential issues. What's really important is to be able to understand taxes such that when you're interviewing a client, particularly a seller, you have some sense or idea of what kind of tax liability they may be looking at, because that could seriously impact what they do. And you need to recognize, what sort of options they may have, and knowing, hey, you need to talk to a CPA or a tax attorney about this transaction, and ideally before they even decide to sell the property, okay? And so that, and that's another reason why, I try to go through this as much detail as possible, so that you can recognize issues right from the beginning. There's another part of this, and that is knowing the tax laws can really set you apart from a lot of other real estate agents. And in communications with prospective buyers and sellers, you can find yourself in a position where they're going to gravitate to you because you know certain things that the average real estate agent doesn't know. And I can share multiple stories with you, and I'll share some stories throughout the class of situations where I've been in where I have said things to people and they're going, no one ever told me that before. Even in some cases, even their CPA didn't share things with them. And in some cases, they ended up selling a property and paying a lot of taxes that they shouldn't have paid because they didn't know what their options were. So again, this is all about just familiarizing you with all these various things so that you're aware of it, and then you can identify the issue. I don't expect you to have the answer, but you need to be able to identify the issue so that you can make sure that they get the proper advice before they go forward, because it can have significant ramifications from a dollars and cents standpoint. Now, in your handout, there's a lot of flyers regarding different aspects of taxes. And a lot of what I've given you is for you to take and read so that you have, can, to the extent you want to learn more about any specific thing, you've got the information there. Now, with that said, everything I have is from Chicago Title. If you work with another title insurance company, I'm sure they have the similar handouts. And these are excellent handouts to use with your clients. Either one-on-one with a particular client, depending on what kind of questions they're having, or you can use these as lead generation pieces, as mailers. You could email them, you could mail them, because they're real estate, they're relevant, real estate information. So keep that in mind. A lot of what I'm giving you, I've got the outline that I've shown you, what I'm gonna go through in detail. We're not gonna cover all these flyers, but I just want you to kind of keep an open mind, because a lot of times we'll talk about, doing monthly mailers or quarterly mailers, and I'll get people ask me, well, what do I send? Well, you'll find that a lot of these flyers that are in here are perfect examples of what you can send to your database. Now, this first flyer is just basically an overview, somewhat similar to the outline that I've given you. And again, so this is a 2-page document that goes just kind of, come on here. This is not going into the, okay. It's a 2-page document that just kind of outlines the broad areas that we deal with in real estate. Federal requirements, withholding requirements, California withholding, FERPTA, change of ownership bonds, transfer tax project. This is a good 2-page document just to give to, say, a buyer or seller on your first meeting with them, just to kind of give them an overview when we talk about taxes. Now, the first tax that we're going to talk about, which is one of the most important that we deal with, is property taxes. And just so I have a sense here, how many people own a home? We've got three or four of you, and the rest of you don't. Okay. Well, most of you should know this. When we talk about property taxes, when we estimate how much the taxes are going to be on a property, what we use as a standard in the industry, and lenders use it to determine how much the taxes are going to be on a monthly basis, we use 1.25%. Okay? Now, not every city comes out to 1.25%. Now understand, property taxes are made up of 2 components. One is an ad valorem. It's an ad valorem tax based on the value of the property. It starts out at 1%, but then it can be higher depending on the city, and it varies from city to city. And I looked at my tax bill so the ad valorem tax rate for my property in Fremont is 1.139, and in a property I have in Union, that I sold in Union City, the rate is 1.2328. Now that's the rate that's applied to the value of the property. You also have what are called fixed charges or special assessments that appear in the upper right-hand corner of the tax bill, and those can be things like mosquito abatement, sewer services, those sorts of things. And those fixed charges can vary from property to property. My tax bill, my fixed charges are $737. On the Union City property, they're $1,416 because they have a large assessment for refuse and yard waste of $486 that doesn't even appear on the Fremont bill. Now, when you run the numbers on my property, my effective tax rate, when I take the ad valorem tax based on value and add the fixed charges, my effective tax rate is 1.243. Now, you're gonna find, not everybody's gonna be exact, but that just gives you a rough idea. That's very close to 1.25, right? Almost exact. The Union City property is 1.324. It's actually a little higher. But because and Newark is fairly close to Fremont. But I'm just letting you know that we use 1.25 as a standard. That's not the exact number. It's gonna vary from city to city. Does everyone know that you can go online to a county website and you can pull up a tax bill on any property? Has anybody ever done that? Are you aware that you can do that? You can go to Alameda County's website, you put in an address, and it'll give you, you can pull up a copy of the tax bill for that property. And it's a good thing to do that with, our contract says that the buyer and seller are supposed to get together and exchange the property tax bill. And that's really not done on a regular basis. My recommendation to you is when you close escrow for a buyer, go online and pull the bill and send them a copy of the bill, okay? Because depending on when you close, they may have a tax bill that they're gonna have to pay that they never see a copy of. Or at least tell them, go online. Now, we're gonna talk about tax dates and so forth, but I'm just kind of giving you an overview. Just want you to be aware of that. You had a question?
Yes, a yearly payment?
Yeah, this is the annual tax bill. And you can go back and see the history of the prior year's tax bills. You go back multiple years on a property. Now, the one thing that you don't see when you pull up a tax bill is you don't see the owner's name. So that the public can't go into tax records and see who owns a property. But we can, because in the MLS we have the tax records. But anybody that just looks for, anybody could drive by and go, oh, I wonder if they're current on their taxes. You go into the website and it'll tell you right away whether they're current or they owe taxes or not. So the property taxes are based on, when we estimate them, 1.25% of the purchase price. Now, what happens with property taxes when the property is sold? Well, under Proposition 13, property taxes are reassessed when there's a change of ownership in the property. And we deal with changes of ownership in all of our transactions, where there's a seller and a buyer. Seller has a particular tax rate, property sells to the buyer, the property is going to be reassessed at the purchase price. But keep in mind, Proposition 13 assumes the purchase price is fair market value. What Proposition 13 says is that upon a change of ownership, the property will be reassessed to its fair market value on the date of the change of ownership. And it goes on to say that there is an assumption that the purchase price is fair market value. What does that mean? That means that if a seller sells a property to a buyer at a significantly lower price than fair market value, when the county assessor's office processes that change of ownership, they can assess the property at a higher price. So you don't ever want to let your buyers think that the taxes are automatically going to be based on the purchase price. And what happens a lot is you get in a family situation, a parent and a child, and they go, oh, well, I'll sell your property for, $500,000 when it's worth $1.5 million. The child's property taxes, now when we get into parent-child, there's a whole other issue with the use of the property and so forth, and we'll get to that in a second. But just stick with me just for my example. Their taxes are not going to be based on $500,000. They're going to be based on, assuming $1.5 million is fair market value, it's going to be based on $1.5 million. I'll give you an example. I was involved in an off-market transaction where the property was sold for $850,000. 10 months later, about 8 months later, the supplemental tax bill came in. The assessor assessed it at $1 million. So that was the buyer's taxes. Taxes were based on $1 million, not on $850. So I told the buyer, the bad news is your taxes are higher. The good news is you got a good deal on the property. Because they actually bought in the assessor's eyes, they bought the property for $150,000 less than fair market value. There's an example. Some people owned some property that Mark Zuckerberg of Facebook wanted to buy, and they put together this deal and they sold it to him for $6.2 million, and they went to do the transfer because it's over 55 transfer, and the county came back and said property's only worth like 4.3, and so they had this huge tax. I think they're still litigating with the county over it because they thought their taxes weren't going to go up at all, and the assessor said no, that property wasn't worth what you thought it was. William?
So does that happen very frequently? And the second question is, how do they assess the value if they don't?
Based on based on comparable sales. The
Oh,
assessor's
they
office.
false.
Let me tell you this: there is no one anywhere that knows the value of property better than the assessor's office, the county assessor's office. They know every comparable sale.
Oh, so
They're familiar
we
with-
should call them and ask them.
Yeah, really, yeah, they would help you, yeah. No, they know the value of everything. Now, occasionally, I mean, I've been doing this long enough, I will get calls from the assessor's office occasionally on unique properties where they're trying to work up an assessment on a property, and they're looking for comparable sales information. And I've had them call me personally on some of my listings that were kind of unique, and then they'll ask me for more information about that property. But yeah, now you can appeal an assessment if you think it's unreasonably high, but you've got to have data to support it. And I've been involved in that, and it's not easy to overcome their value because they have access to everything, and they're on top of it. So don't think that it's going to be that it's going to be an easy thing to do. Okay. You first asked how often does it happen. I don't believe it happens that often, but it would. You'll kind of know it. I mean, sometimes it's going to be an obvious situation. Now, think about it. What's going on right now? We're in a declining market where values are going down, so it's going to be easier. It's going to be easier to get a lower valuation because of the declining market. But still, there's a point where they're going to look at it and say, that's too low. Now, I'll tell you the perfect example. I once spoke to a big group of agents in the Lesher Center in Walnut Creek, and the speaker before me was Gus Kramer, the assessor of Contra Costa County, and he's the one that got in some trouble and stuff. And he told everybody, he goes, because when you do the transfer, the Prop 55 transfer, you want to sell your property and buy another, and you can only buy up to so under the old rules you can only go up so high on the price. Well, what agents would do to try to stay within the acceptable price, they take the commission out of the deal to lower the price, and have the seller pay the commission direct to the agents. He goes, we look very carefully at those applications because we know that goes on a lot. He goes, we see through that almost all the time. When they run the numbers, they can tell that the price that was submitted is running about 5 to 6% less than actual fair market value. He goes, we'll catch it almost every time because we know the numbers so well. And so his warning to everyone was, don't do it because we're going to catch it. Okay.
Steve,
Yeah.
would you say that 90% of the time the assessor uses the purchase price as the assessed value?
Probably more than that. No, he asked, I said very little. I would say probably 99% of the
Okay,
time.
so 99% of the
Yeah,
time,
yeah,
the
yeah.
sales price
I don't
is the
think
assessed
I don't think it
valuation.
comes up that much. Yeah, like I said, I only know of 2 or 3 situations where it's happened. But again, there's gonna be a point where if you come up too low, they're probably gonna question it. Okay.
And aren't there there's some cases where some properties can be exempt from property taxes, like in the case of churches and things like that?
Yeah.
Some nonprofits.
Yeah. Mm-hmm. Okay. So understand that you've got property's gonna be reassessed when there's been a change of ownership. Now there are some exemptions, and if you look at the next document, the preliminary change of ownership report. Okay, this preliminary change of ownership report is completed in every closing that we do. And this document is completed by the escrow officer, and it's signed by the buyer, okay? And the first part of it is transfer information. And basically, that first paragraph, part 1, that's asking questions about the transaction to determine whether or not it may be exempt from reassessment, okay? And the most common ones are transfers between husband and wife, where you've got, you're adding a spouse, there's been a death of the spouse, there's been a divorce, maybe there's some name changes. Another real common is the creation of a joint tenancy, where one of the original transferors is still on title. And then another common one is when you're transferring property to a trust. That's not considered a change of ownership, because the owners are the trustees. So there's been no change of ownership. Now, when you get to transfers between parents and children, that used to be an outright exemption. Until Proposition 19 passed, a parent-to-child transfer was exempt regardless of the type of property. Okay, as of February 16th, 2021, that's no longer the case. Parent-to-child transfers are only exempt under Proposition 19 if the property is the parent's principal residence and the child is going to live in that home as their principal residence.
So
And
real
the
property
child
can be
has to move into that property within 1 year. So if you have parent's principal residence transferred to child, and child is gonna move into it as their principal residence within 1 year, that transfer will be exempt from reassessment. And that can be huge. You got a parent that's owned a home for 30, 40, 50 years, taxes are running $700, $1,000, and based on assessed value, the property taxes could be, if it was $1 million property, tax would be over $12,000. Huge savings. That's the only parent-to-child transfer that's exempt. Any other property, if it's parents say parents transfer a property to a child, and a child has their own principal residence elsewhere, that property is going to be reassessed. Parents pass away and leave property to their children, it's going to be reassessed, the value at date of death. That was the giveaway that we as an industry had to give up to negotiate with the legislature to get Prop 19 on the ballot the second time. That was negotiated in Sacramento, was to give up the parent-to-child exemption with the one carve-out being the principal residence. So that's huge. Now, there are some ways around it, dealing with trusts, corporations, and that is dealt with more in the commercial side. Now, imagine like these buildings here that the landlords own. They don't own these as individuals, but if they did, and this is true for anybody, any parent that owns a commercial building, a big expensive commercial building, if they own it as individuals and they pass away and they leave it to their kids, it's gonna get reassessed at date of death.
And the tenants are gonna get hit.
Yeah, so that, that's, okay, so remember I said earlier, I'm giving you things to be aware of. If you have clients that you know own a lot of property, and it's appreciated a lot, and it's in their names as individuals, they need to go talk to an estate planning attorney, because they need to get those properties into a trust and or into a corporation, or possibly an LLC. They need to get it into a different entity other than themselves, so that they can try to avoid the reassessment of taxes upon their death. Now remember, right now, all I'm talking about is property taxes. We're going to talk about another issue. We're going to talk about capital gains taxes a little later on. Right now, I'm just talking about the annual property taxes on the property. Everyone follow me? Everyone understand what I'm talking about? See, when Prop 19 was going to go into effect, there was a mad rush. I helped 3 or 4 clients transfer properties to children and before that February 16th deadline, so that the properties wouldn't be reassessed later on, so that we could keep but that date's come and gone. That was February 16 of last year, and there was a mad scramble for parents who had, a typical example is parent has a rental property that the child's living in, maybe paying rent, maybe not. And the goal was to ultimately give that to the child anyway. Well, to keep the taxes low, you had to give it to the child right away. Once February 16th, 2021 passed, too late.
What happened to the gift tax?
Well, the gift tax limits are so high that see, right now under current law, each person has to have an estate over $11.5 million before they have a state tax gift tax competence. They have to file a gift tax return for that transfer, but it's so low relative to a married couple's looking at over 23 million before there's any estate tax consequence. So the average person didn't have an issue to deal with. But yeah, they do have to file a gift tax return for that.
Because
Yeah.
income.
But they don't pay any tax. They're just they're using up what's called a unified credit. It's just by lifetime gifts reduce the amount of the estate such that taxes kick in at a lower amount. Most people don't have to worry about that problem. Okay. The other exemption from reassessment can be when you have what we now call the Prop 19 transfer by someone who's 55 or older, and we'll talk about that in a second. I want to stick with the normal stuff that we deal with when it comes to property taxes. So I would, if you've never seen this document before, I would suggest that you do take some time to read it, just so you know, because what's going to happen is if you go to a sign off with your buyer, questions may come up about this form, and it's good for you to know what's in this form, so that, because the escrow officer may or may not be able to answer the question, depending on what it is. So it's always helpful for you to be there to try to help answer questions depending on what the question may be.
Steve?
Yeah.
Which states that everybody real estate agent should always be at the sign off.
They should be, yeah, should be,
If you wanna.
but it's not, yeah.
It's not
yeah.
mandatory.
Yeah, well, because of COVID and because of COVID and because of mobile notaries, it's not happening like it did before. A lot of sign-offs are not even happening at the title companies, okay? They're all happening at the client's house.
Unless the
Yeah.
client feels more comfortable with
Yeah,
what's
yeah,
going on.
yeah, but it's,
plan.
like I said, we've gotten away from it because of COVID. Okay, it's just not, it just doesn't happen as much. Okay, next thing is, when it comes to property taxes, in escrow, and here's where it gets confusing for buyers. In escrow, we prorate taxes based on seller's tax rate, not on the buyer's taxes, okay? We prorate taxes based on seller's tax rate, and then 6 to 8 months after close of escrow, the county assessor processes that change of ownership report and then issues what's called a supplemental tax bill. And that supplemental tax bill is for the difference between the seller's rate and the buyer's new rate. Now, the tax year starts on July 1st and ends on June 30. Now, don't ask me why they didn't go with a calendar year, but that's how it is. I think part of it has to do with, it used to be they assessed properties, it was March 1st, they used to assess the property, and then the tax bills would come out thereafter for this tax year. Now they assess properties on January 1, but they still left it this way. So you got 2 installments of taxes. The first installment is for July 1st through December 31st. The second is for January 1st through June 30. Taxes are due. The first installment's due November 1st and is late if not paid by 5 p.m. on December 10th. The second installment is due February 1st and is late if not paid by 5 p.m. on April 10th, 5 days before the next big tax date. Okay, so you got a double whammy in April. You got to pay your property taxes by the 10th, and you got to pay your income taxes by the 15th. And you all know that even if you file an extension to file your tax return, you're still supposed to pay your taxes in full on April 15th. An extension doesn't include an extension of paying taxes. If you wait and pay your taxes by October 15th, you're going to pay penalties and interest for all that time. Okay. But you don't have that to worry about because you're all paying your quarterly estimated taxes,
Oh, sure we
correct?
are.
Yeah, wink, wink.
Sure we are.
Okay, we'll talk about that later too. All right. So we say, so taxes are prorated and closed. So how does prorations work? Well, first question is, what's our close of escrow date? Let's I'm going to explain this to you. If taxes are due or going to be due within 30 days after the close of escrow, then the escrow officer is going to collect taxes for that installment from both the seller and the buyer. If taxes based on the close of escrow date, taxes are not yet due for that installment, they'll only collect from the seller for the portion of time the seller owned the property. And then the buyer will pay the full installment. But the buyer will have already received a credit from the seller for the portion of time that the seller owned the property. So what I mean by within 30 days of the due date, if you have an escrow that closes on October 1st or thereafter, in most cases, the escrow officer is going to collect from the seller and the buyer. So they're going to prorate that 6-month period and collect each one share in full. Which means when you get to the first of the year, if you close after January 1st, because you're within 30 days of February 1st, in most cases, the escrow officer is going to collect from both sides for any closing at the beginning of the year. They're going to collect from both sides because taxes are coming due on February 1st. So let's just take a scenario. Today is November 16th. Let's say today is the close of escrow. Okay? When we prorate taxes, the seller is paid, the seller's going to pay from July 1st through the day before escrow closes. So close of escrow is the 16th. The seller's going to be charged, they're going to prorate the tax installment and charge the seller from July 1st to November 15th. And then the buyer's going to be charged from the 16th to the 31st. Now, what's the contract say as far as how are prorations done? Prorations are based on a 30-day month. So you forget the 365, you forget it's based on a 30-day month. So if we have an escrow closing today, how many days, this is where you get to pull out your calculator, or if you pull it, count in your hands, how many days is the seller going to be charged for property taxes if escrow closed today? Free lunch to whoever gets the answer right.
14 days?
Free lunch?
14 days? No. How much are we going to charge the seller? Now, first, let's go back. Let me get back in.
Starts one day.
Okay, we're going to. Okay, first of all, we have received our tax bills. Okay, but they're not due till December 10th. The seller may have already paid the installment. So if the seller already paid the installment, we're not going to charge the seller anything because they've already paid the installment. But we're going to charge the buyer, and the seller is going to get a credit back from the buyer for this time period, if that's the case. Most people don't pay them until towards the end, closer to December 10th. I mean, why give them the money early? Let it sit wherever it is and earn interest. Don't pay them until you absolutely have to. So we'll go back. If the seller, because tax bills have already been received, if the seller's already paid it, then there's no proration to the seller because they've already paid the installment in full. We're going to charge the buyer from November 16th to December 31st. The buyer's going to pay that amount, and that amount's going to get credited to the seller, so that the seller's only paying taxes from July 1 to November 15th, and the buyer's paying for the remainder. Does everyone follow that? Okay. Now let's assume the seller hasn't paid the bill, and this is one of the things that light should go on with you. If you're listing and selling a property, and the seller hasn't paid their taxes yet, and escrow is going to close no later than December 10th or no later than April 10th, you tell your seller, don't pay the taxes because they're going to be paid in escrow. Now that may help some of your sellers because they may not have the money. I've seen that. I've been there. I've got it where they don't have the money. I said, don't worry about it. As long as we close by this date or this date, you're fine. Because the escrow officer's going to collect that money and it's going to get paid out of the sales proceeds. They don't have to write a separate check or go online and make the payment. Does everyone follow me? Keep that in mind because you're going to run across sellers who are going to be tight on funds. And it's going to be a blessing to them, especially what's right around the corner from December 10th? Christmas. If you can tell them don't worry, you can go buy presents all day long with the money you would have normally paid for property taxes because they're gonna come out of the sales proceeds. Follow me?
Was it 15 days?
No.
No? Close on 16th?
Who said 135? You get the free lunch.
Oh, okay.
You gotta charge, how many
15
days?
plus 30.
July, 30 days, August, 30 days, September, 30 days, October, 30 days. That's 120, plus how many days in November? 15, 135 days. And if it's a 180-day month, then what's the buyer charge? 45 days, 45 days. So you take whatever I'm gonna make this really simple. Let's say the installment is $1,800. How much does the seller pay? The two of you should know it. The whole installment is $1,800.
The seller pays that.
How much does the seller pay of that $1,800?
They get a credit check from the buyer.
No. We're closing escrow on December 10th.
Okay.
We're closing today. We're inside this. Seller hasn't paid it yet. The seller is charged $1,350. And the buyer's charged $450. Okay, what part of that don't you understand? Don't be embarrassed. There's no dumb questions. Everyone understand it now? I can tell from your eyes that you're not all understanding it. Questions? You need to know this. If you're going to list properties, you need to know this, folks. This isn't something you give to your TC to worry about. This isn't something you give to the escrow officer to worry about. You need to know this. You all understand it? 100%? Okay. Now, this is assuming the seller didn't pay the installment. If the seller had paid the installment, in other words, the seller had paid the $1,800 in full, then this goes away, but the buyer's charged that, and it's credited back to the seller, so that at the end of the day, the seller paid taxes for the portion of time the seller owned the property, and the buyer paid tax for the portion they own the property. Now, what happens to this installment? There's another $1,800 installment. The buyer is going to pay that $1,800 installment
Plus.
no later than April 10th. Plus, at some point, 6-8 months down the road, it may not even be before April 10th. It may come after April 10th. The buyer's going to get what's called the supplemental tax bill. And that's going to be the difference between the taxes on the purchase price and sellers. See, in this example here, the seller's paying $3,600. Let's just say, just for sake of this discussion here, let's say the purchase price is $1 million. How much do we estimate the taxes if it's $1 million? Jerry, don't answer. Jerry, don't answer. If the purchase price is $1 million, how much do we estimate buyers' new taxes to be for that property? 1.25%, which is how much? $12,500. So if we estimate buyers' new taxes based on $1 million property at $12,500 and seller's $36,000, what's the difference? $8,900. Now, we're going to talk about how that's not the amount the buyer's going to pay. The buyer's going to pay a prorated amount of that. based on November 16th to June 30. And I'll explain that to you in a minute when we get to supplemental taxes, the detail, how that's calculated. I just want to show you just the big picture. Buyer's taxes are 12.5, the sellers are 36. The difference is 8,900, but the buyers, that's going to be prorated from November 16th to June 30. Okay, because they're not going to pay for a full year because they only own the property for a portion of the year. Okay. Okay, let's move.
I have a quick question. What are the points?
Okay, that's what I'm going to get to. Right, that's what I'm doing right now. That's what we're doing next. So let me. Okay, is everyone?
Where did 3,600 come from? 3,600.
This and this, the seller's taxes. The sellers, this is installments. The seller's taxes are $3,600. So what's going to happen is the 12.5 less 36, this is the amount that would be owed for the full year, but the buyer's only going to be charged from November 16th to June 30. So there's a factor that we use, and we're going to get to that in a second, okay? No one has any questions so far? I know you do. No one wants to ask. Okay. In our example, we'll go back to our example. I'll stick with this number. Okay, go to okay. Everybody find that chart? Understand supplemental property taxes? So the way it works is the supplemental tax becomes effective on the first day of the month following the month in which the change of ownership occurs. So you've got, in our example, we're closing escrow on November 16th. So the change of ownership is in November. The tax becomes effective on the first day of the month after the change of ownership. So if change of ownership occurs on November 16th, what is the effective date for supplemental taxes? December 1st. So the effective date is December 1st. So you see on your chart, the right-hand side, about halfway down, effective date December 1st. What's the proration factor?
0.67.
What's the factor? 0.58. So what do we do with 0.58? Multiply 0.58 times 8,900. What do you get? You guys all know where your calculator is on your phone? You should. Should be right there. I use mine constantly. What's the number?
5,162.
What is it?
5,162.
62? So that's how much, that's the supplemental. Now divide that by 2.
2,581.
2,581. So what's going to happen is about 6 to 8 months after close of escrow, that buyer's going to get a supplemental tax bill for $5,162, and they're going to have an opportunity to pay it in 2 installments, probably coinciding with the normal tax bill. They're going to be able to pay it in 2 installments for $2,581. Now, I'll suggest to you that when you're dealing with a first-time buyer, that you go through this exercise with them. because that's what I do. And then I joke with them. I tell them, I'm gonna bet you lunch that you're gonna forget this conversation. And then what do you think happens? 6 to 8 months go by, ring, ring, my phone starts ringing. Supplemental tax bills that hit the mailboxes. And the buyers call up, and I just got this bill from the county. I thought I paid property taxes in escrow. And I say, you owe me lunch. Because they forgot my conversation. The taxes they paid, what were the taxes the buyer paid in this escrow? The buyer paid $450, which was a portion of seller's taxes for the portion of taxes owed by the seller. I told him, you're gonna get a bill 6 to 8 months from now, and this is approximately how much it's gonna be. So I suggest, first time buyer, I'll tell them, you know, you should probably start saving about $500 a month. As soon as, from the time we close escrow, start saving about $500 a month. So when you get this bill, you're not gonna freak out because you've got the money saved. Now, how often do you think they save it? Usually when I get that call, you know why? Because they haven't saved a penny. They don't have that much money. They haven't even budgeted for it. So you do them a favor by going through this exercise. There was questions going on back there. What was the question? What was the issue?
Oh, is it possible to pay that tax at once? Like you don't have to do the 2 installments that you
Oh, you can pay it all together. Yeah, you can pay it for, when you get the bill, you can pay it right away, be done with it. You don't have to wait. They give you time, but yeah, you could, I mean, the first installment's due, I just was going through my mail, oh, I got that coming up on the 10th. I mean, yeah, I could pay my full installment by December 10th and not worry about the second one and be done. Oh, they'll take your money early, no problem.
for benefits or no?
No, there's really, I mean, again, it depends on where you have that money. If you already have the money sitting somewhere earning interest, you're losing interest on that money by giving it to them early. So if you have it sitting in an interest, you know, there's not, well, savings rates are going up, right? So you are starting to get some money on your savings, 2%, 3%, and depending on where you put the money. Generally speaking, if you've got money earning interest, you leave it in there as long as possible and pay the bill as late as possible. Because otherwise you're giving them that money early and you're losing that interest. Does that make sense? Yeah. But as soon as you get the bill, I know people, as soon as the tax bill comes, they write a check for the whole amount just to get it be done and over with. Yeah.
Where do the proration factors come from, and do they ever change?
No, they're set in stone based on the month of the year.
Okay.
Because you take the whole year and it just goes down, goes from 0.92 after 1 month to 0.83 to that's a preset numbers based on the months and the 12 months of the year.
Then I have a second question. You said sellers shouldn't pay the taxes if they sell their house within the brackets of November 1st and December 10th.
Well, from the time they get the bill until, if escrow is gonna close, no later than December 10th or April 10th. Remember, you got first installment due December 10th, second installment due April 10th. If escrow's gonna close no later than December 10th, or if we're in the first half of the year, or escrow's gonna close, tax bills come out, and escrow's gonna close no later than April 10th, don't have them write a check and pay the taxes. Have it come out of their sales proceeds. And again, the reason I say that is because for a lot of people, it may be a struggle to pay the taxes. Now, remember, we're going to talk about impound account here in a minute, because there's an option for a first-time buyer, or any buyer for that matter, to have an impound account. What happens with an impound account? With an impound account, part of your payment to your lender includes 1/12 of your property taxes, and can include 1/12 of your homeowner's insurance. That way, you're paying as you go, and then you never have to worry. I highly recommend to a first-time buyer who's never owned a home before, that's just getting by, to set up an impound account. But if they make more than enough money, they want to control their finances, they want to invest that money and earn interest on it, then don't do an impound account. Be in control of your money and pay it at the last possible day. Just depends on how well they manage money and can budget. Yeah.
Do all lenders allow that?
Yeah. Any lender will allow it. You can do it. Now, some lenders on some loans require an impound account. What do you think might require an impound account? FHA, VA, their impounds are required on those. But on any conventional loan, a lender will gladly do an impound account. I've never heard of a lender that say no. A hard money lender might, but not. But any conventional lender will, yeah.
I do that on my rental properties just to make sure that taxes get paid.
Yeah. So next on our list is impound account. Again, I basically have, remember these flyers. I mean, if you get, these are great to hand out to people, depending on what questions they may have. So there's a schedule for impounds, because the way the impound account works is, because of the due dates for taxes, when you set up an impound account, the buyer is making a monthly payment to the lender's collecting the money and holding it in an impound account. The lender pays the property tax bill. And if you do homeowner's insurance, the lender pays the homeowner's insurance bill. So how does it work with property taxes? With property taxes, if you go by what month is the loan funding in. So let's stay with our same example. If the loan funds in November, when's the buyer's first house payment? You can't answer, Jared. January. That's another thing to always remember, because if you got to close of escrow on the 16th, is there a payment on December 1st? No. Well, why is that? Why is there no payment on December 1st? One at a time. Because interest is paid in arrears. Okay? What does it mean, interest paid in arrears? Interest is paid for the month that just passed. It's exactly the opposite of rent. This is a big deal for first-time buyers, because what happens is, let's just say in a typical scenario, if close of escrow is today, the loan, in most cases, funded yesterday. Now it can fund and close the same day. It's becoming more and more the norm. But just generally speaking, you're going to fund the day before and close the next day. And how much is that going to be for? That's going to be for interest from November 15th to November 30th, the end of the month. Now, come December 1st, is there a house payment? No, because they've already paid the interest. That if there was a December 1st house payment, that was going to be interest for November. It's already been paid in escrow. So the buyer's first house payment isn't until January 1. So this is a big deal for first-time buyers who are renting. I make a big deal to let them know, guess what, folks? In escrow, you're gonna pay here. Now, if you gave notice to your landlord such that you can move out before the end of the month, guess what? December 1st, no rent payment, no house payment. You think that's big? You better believe it. Most people live, if you've heard the phrase, paycheck to paycheck. And I mean most, I'm talking about a high percentage of people. A very high percentage of people live paycheck to paycheck. If you can save them a rent payment, that's the mother lode. There's their Christmas presents. They can have a great Christmas because they don't have to pay that $3,000, $3,500 a month rent payment. It's huge. It's huge. There's a reason to buy a house there's a reason to be buying a house in November. You get your Christmas money on December 1st because you don't have to pay rent. Now, so with taxes in our scenario, they have to collect 5 months up front in escrow and that's because of the due dates. Remember what we said, if we've got a due date of November 1st and February 1st, well, the lender has to receive all the money in advance of these due dates to be able to pay the full installment. So they've got to collect the latter months up front. This month or those latter months up front. So if you're going to impound property taxes on that, on a closing today, that buyer's got to pay 5 months into escrow. So how much is that? What did we say? We got $1 million property. Taxes are 12.5. How much is 5 months? Okay, Alex is quick. Jerry can't answer. Somebody, Jenny knows it already. William probably knows it already. Someone else. 5,200. Yeah. So the 5 months. So that's a big amount of money to add to buyer's closing costs. And remember, on the FHA and VA deal, it's required, but you can do it voluntarily. But the buyer's got to have that extra money, because remember, otherwise, in our scenario, in escrow, the only amount the buyer was going to pay was $450. But if they're going to impound, they've got to pay $5,650 because they got to pay the $450 and the $5,200. Everyone with me? Now, if you're going to do insurance, generally speaking, they're going to collect either 2 or 3 months of the insurance up front. Now, that's not a huge amount. I mean, typically, let's just assume you've got $1 million house, a 3-bedroom, 2-bath, 1,200, 1,400 square feet. Your insurance is probably running you about $900 to $1,000. Let's just say it's for easy math. Let's say it's $1,200 for insurance. That's $100 a month. So they're going to pay $200, maybe $300 up front in the impound account. And then what happens is, now, here's the other little caveat. What happens to the supplemental tax bill? It varies from lender to lender, and that's one of the reasons to, as a buyer's agent, to review the buyer's loan documents, because in there is a document that says how the supplemental tax bill is going to be handled. Is it going to be paid by the lender, or is it going to be paid by the borrower outside? I've seen them where it's paid by the borrower outside. Now, that's the bad news, because they basically paid a chunk of it already, and now they're being told to pay the supplemental tax bill. So that's the bad news. The good news is, at the end of the year, the lender has to audit the impound account and has to refund the buyer any excess funds that are being held. In the old days, they didn't. They just held onto that money and used it themselves. Now, every year, they have to audit the impound account. and they can only hold the necessary amount needed in reserves for future payments. Any excess has to be paid. So the buyer would ultimately get money back. But just be aware of that, because that can be a big gotcha. And there'll be a document that says how the impound account, how the supplemental bill is handled. Everyone follow me? Any question? There's no dumb question. Okay, understanding who's heard of Mello-Roos? Basically, Mello-Roos, you'll see it predominantly in less affluent counties with lower property values, lower property taxes. A builder comes along and says, I want to build this development, and they go, well, we need infrastructure here. We're going to need parks, we need a school or a police station or whatever it is, and we don't have the money. We'll approve your development, but you got to set up a Mello-Roos district, which means bonds are going to be sold to collect money to build that infrastructure, and the homeowners are going to make payments, monthly payments on their property tax bill towards Mello-Roos to help pay off the bonds that were sold, okay? We don't have a lot of it in the immediate Bay Area. We have some, not a lot. It's more predominant when you get over the hill, particularly out in Central Valley. But we're starting to see a little bit more of it. What's that?
Contra Costa.
Contra Costa, yeah. Now we've got there's one area in Contra Costa, the name, I keep forgetting the name of the development, but the property taxes are like 1.9% or whatever because they've got huge Mello-Roos. It's in San Ramon. Yeah. How long is Mello-Roos in effect for? It can be in effect for up to 40 years. We had a development in Union City off Alvarado Niles. As soon as you went over BART on the right there, they had Mello-Roos, but theirs was only in effect for 20 years. So it depends on the length of the bonds that are being sold to collect the money to build that. So you just make sure that when you venture outside of the normal area where you work, make sure you check the MLS or the tax bill to see whether or not there's Mello-Roos. Because the Mello-Roos will appear you'll see it on the tax bill. It'll show up in this upper right-hand corner on the tax bill as a separate line item on the tax bill. All right, Proposition 19. So we talked about the parent-to-child transfer. Everyone's clear on that? It only applies on when it's parent's principal residence and it's going to be child's principal residence within 1 year of the transfer. Now, we didn't talk about, there is an exclusion for grandparent to grandchild. However, the parents have to be deceased. Okay? Both parents have to be deceased for the grandparent to give property to a grandchild and have it excluded from reassessment. But again, it's still got to be principal residence, as same as child. Okay, Proposition 19. So Proposition 19 is a big deal, especially given the number of people that are in my generation, the baby boomer generation. There's lots of us that are over 55 years old and own homes and want to sell and move somewhere else, and we want to take our low assessed value to the new home. Now, before Prop 19, there was limitations. You could only go up to, you know, if you sold first, you could only go up to 105% of what you sold for during year one, or 110% in year two. There was a limit as to how high you could go on the price. And you could only do it once. And you could only move, there was only about 9 or 10 counties where you could do it, okay, in California. Well, with the advent of Prop 19, there's no limit on the price. But there's some consequences depending on how high the price is. And you can do it anywhere in California. And you can do it 3 times during your lifetime. And that's important because I know I had some people that I was helping, and you know, when it was all, you could only do it once, and they were going from Fremont to Livermore, and they were, you know, they were my age, and we started looking at 2-story houses. I'm going, you sure you want to use this, because you only use it once. You sure you want to use it on this 2-story house? Because I don't see you living in this 2-story house forever. I said, you either don't do it on this one, or we need to concentrate on single-story houses. So then they finally got it. They said, oh yeah, we can only do it once. We better buy a single-story house. You know, and that's what they did. And they're still there. Well, now you can do it 3 times. So you could move once into a big house, another big house, and then turn around and do it again into the single story later on. Now the way Prop 19 has the, look at the next, it has that 105, 110% component in it. In other words, if you buy a property before you sell, then you've got the property that you buy has to be equal or less than the price you sell your property for later. You don't have any factor above it. But if you sell first, equal or greater in value includes another 5% if you buy within a year. So you can sell, let's say, I'll give you this example. And this is basically, this is a, oh, there it is. This is a
1690 and 110 don't apply anymore, do they?
no. They basically, Prop 19 is taken over.
That's what I thought.
Yeah, because Prop 19 applies to Prop 19 applies to 55 and over, disabled, and wildfire victims. Okay, it applies in those 3 scenarios. We used to have different propositions for 55. You had 60 and 90. 60 was in your county, 90 was in another county, and 110 was for disabled. Now they're all under Prop 19. So let's say you sell a house for $1.5 million. And let's say that person's owned that home for, 40 years, 40, 50 years, which isn't unheard of. There's a lot of people, my parents' age that, I mean, I sell a lot of houses of, people my age that they inherit. It was the parents' house the parent had for 30, 40, 50 years, the house they grew up in. I'm selling a house right now. I just went into contract yesterday, a house in Niles where my clients, the 2 brothers, it's the house they grew up in the 60s. So the taxes are really low. So let's just assume they sell a house for $1.5 million, assessed value is $100,000. Now, if they buy the first year, how high can they buy and keep this assessed value? Which is say right here. There's no adjustment to transfer base value if the replacement property is of equal or lesser value than the original property's market value. Equal or lesser value means 105% if replacement purchased in first year after sale. So what's 105% of the 1,000,005? 1,575,000. So now under Prop 19, the seller is over 55, sells their house for $1,500,000. During the next 12 months, they buy somewhere in California a property for $1,575,000 or less, and no matter what price, and they're going to keep that $100,000 assessment. Their taxes are going to continue to remain on that low value. Now, I jumped ahead real quick on Prop 13. One thing I didn't explain to you. What Prop 13 says is that as long as there's no change of ownership, the maximum increase on an annual basis of the assessed value can be no more than 2% annually of the assessed value. Assuming 2% assumes inflation or CPI index is at least 2% or higher. Well, that's been a no-brainer now, okay? In the history of Prop 13, there's been between 5 and 10 times when it hasn't been 2%, where inflation is really low. But just understand, Prop 13 can increase the value. So, for example, if the assessed value now is 100,000, if inflation CPI is 2% or greater, next year, what's it going to be? 102,000. That's the assessed value, but it's still the same tax rate, 1.25%. So in that scenario, what's 1.25% of $2,000? $25? Right? 25?
I think so.
Well, go
25.
2,000 times 1.25%. $25. So in that scenario, the taxes only went up, if the assessed value went from 100 to 102, the taxes only went up $25. Because 1.25% of 2,000 is $25. Understood? My point is, the annual increase in taxes isn't that significant depending on the actual tax rate. And they do go up, but they only go up by 1.25% of that maximum 2% of the assessed value. It's not the tax rate that goes up, it's the assessed value. Question?
So when someone older sells their house for using the same, can the kids help in the purchase? Can they be on the title?
No, that change. Yeah, when you start dealing with that changes everything. No, under Prop 19, it's got to be the same people. Now you can. There's a lot of different permutations of this, and there's a Q&A that the county has that explains how you're bringing on other people and whatnot. I don't want to get into that. Okay, I want to just keep this just basic. There is a Q&A. Now remember, when you got husband and wife, only one spouse needs to be 55. The other spouse doesn't have to be 55. Only one has to be 55. There's a whole bunch of other Q&As on that. So that's what it means. That's what we talk about. As long as you buy something of equal or lesser value, then it's going to. Now, what happens if they buy a house for more than that? For more than $1.5 million? What do you think?
Tax get adjusted for the difference? Tax get adjusted for the difference?
They're going, right. The difference, let's say they buy a house for $1,750,000. that 250 is gonna get added to this.
Basis.
Make sense? Understood? So if you go up more, we're gonna take the difference and add it to the old assessed value. So it's gonna have the original assessed value plus that incremental difference is gonna be added on top. And that can happen. You know, it's still a savings because you still got the low taxes on the 100, you're just paying additional taxes because you went up over. I'm seeing some puzzled looks here. Remember, you're going to get to keep the existing assessed value if you buy something equal or lesser in value to what you sell the property for. And if you sell first, you can actually go up another 5%. So as long as you don't go over $1,575,000, you get to keep the 100. That's huge. Now if we go to so any questions there? Now again, this is something I can tell you that the average person, in my experience, still doesn't know this. This is a huge thing to communicate to your database and to anybody you're talking to. Yeah.
I was up in El Dorado County a couple of weeks ago, and I'm looking around, and I saw all the people who's moved out of the Bay Area up there. It's just-
Yeah, well,
it's
see, well,
staggering.
because prior to there was a window of time where El Dorado County accepted it.
Yeah.
El Dorado County repealed it a couple of years before Prop 19.
It just was amazing
Yeah,
to me.
because they weren't part of the group, and then they became part of the group, and a huge number of people moved to El Dorado County.
Yeah.
Again, how many people do open houses? Raise your hands. How many people do open houses? You all should be doing open houses.
Yeah.
Or getting a listing so you can do hold an open house. One of the benefits of this market is, because it's a little slower, you get to hold the house open longer, not just one weekend. You get a chance to meet more people.
How many offers did you get on your Niles property?
2.
Well,
2, and I almost had a third. But, this is what we just talked, Prop 19 is something you need to internalize because the average person doesn't know it. When people come through and you start finding out, how long you been looking, what are you planning to do? You usually can spot someone that's more than likely 55 or older. I mean, it's probably easier the older the easier, but don't be afraid to ask somebody, when they say, well, now we're thinking, well, don't be afraid to ask them if you're not sure. Well, how old are you? Sometimes I've guessed wrong, or I assume wrong. How old are you? They said, well, if you plan, so now remember, this is dealing with moving within the state of California. So if someone says they're planning to move, because what happens, you get the neighbor to come in and go, so I'll tell you, are you looking for a home or you happen to live in a neighborhood? Oh, we live in a neighborhood. Any plans to sell? No. Well, if you were to sell, when might that be? Where might that be? If they say California, go, well, are you familiar with Proposition 19? 2 out of 3 times, they'll probably say, no. That's where you start a dialogue. That can motivate them. Because what keeps a lot of people in their houses right now is property taxes, is low property taxes. Think about it. They've owned the home, it's paid off, but they're retired, they're on a fixed income, and they can't afford to pay more than, some people still can't afford to pay the property taxes, depending on their situation. Social Security doesn't cover everything, you know, it's kind of sad, but that was the whole idea behind Prop 13 in the first place. Because before Prop 13, property got reassessed at fair market value every year. Imagine what it would be like with the values of properties we have. Imagine how much kind of property tax bills we would have.
My property taxes dropped when Prop 13 came into effect.
Yeah, because it rolled back to 75, 76.
Right,
Yeah.
yeah.
Okay, last thing on, so again, internalize this Prop 19, because it can be, it can help convert someone from staying in their house to selling and moving. Yes?
So the replacement home, does that mean that selling the house is a requisite, or you could still?
You can buy first and sell, I'm glad you asked that question. You can buy first and sell after, but you've got to sell within 2 years, to the date.
You're not leaving, are you?
I'm not a senior.
Yeah. Here's the thing, most people can't afford to buy a house without selling the house they have, the average person. But if you have someone who can afford to buy first, then they can wait up to, they can rent that house out and wait up to 2 years. But they've got to sell it in exactly 2 years from the date that they bought the other house as a principal resident. Remember, this only applies to principal residents. But they can buy another principal residence, move into that, and then they can wait up to 2 years to sell and apply for the transfer. And this is the form. After you close escrow on the second property, that's when you submit the application. And the effective, if you buy first, you pay the full taxes on that property until such time that you sell your property. The low tax rate doesn't come into effect until you close on your original property. If you buy first and then sell later, you're going to pay full taxes on the property you bought until you close on the property that you on your original property. Any questions on that? Now, for another free lunch, if the over 55 buyer bought their replacement property and closed today, by what date do they need to sell and close their previous principal residence? By what date?
Yesterday.
Okay. What did you say?
November 16, 2024.
Did you say November 16th?
15.
15.
Yeah,
15.
Yeah, so you've got, we close escrow today. 2 years from now is 11/15/2024.
So how does that affect capital gains if you rent the property out for 2 years?
Well, we're gonna get to that. We're gonna get to the, we're gonna get to that.
That's really tight.
Okay, let's just, we're gonna talk about combining the capital gains exclusion with a 1031 exchange a little later.
Yeah.
But for now, this is just Prop 19. You got 2 years for Prop 19. Now you asked, how does it affect capital gains tax? jump ahead here real quick. You gotta live in the house 24 out of the last 60 months to take the exclusion. In this scenario here, if you close escrow November 15th, and you moved out of the house on November 16th, have you lived in the house 24 out of 60 months?
Well,
Yes, well, yes, because you lived in it all the way up to here.
Right.
See, this was your principal residence. It's not a probably, that, in order to do this, that had to be your principal residence. See, the property has to be eligible for the homeowner's exemption for you to use it in the first place. So your existing home has to be your principal residence. You buy a new one and move into that, you're no longer in that one, you wait 2 years. But when we look back,
Should you cancel that homeowner's exemption right away, if you were planning on renting it out?
you could, they're really
You know what
loosey-goosey,
I'm saying.
they're loosey-goosey on that. You don't even need to worry about it. You look back 60 months, this is only 24 months. Look back 60 months, did you live in the house 24 out of 60? Yes. So when you sell here, you're still eligible for that $500 exclusion. In fact, I don't want to complicate it, if you take Prop 19 out of the scenario, you can go another year. You can go up to 3 years and still take the
Oh,
exclusion because you've been in it 24 out of, you were in that house 24 out of 60. We're kind of jumping ahead here, but we'll get to that in a few minutes here. So this Prop 19 is huge. Learn this, internalize this, because this can get you clients. This can get people interested in selling and moving somewhere else in California, particularly if they're older. Now remember, this only applies if they're staying in California. If they're moving outside of California, you're not even worried about property taxes. You're not worried about transferring assessed value. The only thing you're worried about is that $250,000 or $500,000 exclusion, which means if they're going to buy a house first and not sell and they're going to keep their California house as a rental. If they want to take the exclusion, they're going to have to do it within 3 years. Once 3 years pass, they'll no longer be able to take that exclusion on the sale, but they can do a 1031 exchange. But they lose that tax-free money, that if a married couple, and we're going to talk about how you can do both of them to get the best of both worlds. All right, moving on. Transfer taxes. How many people are familiar with this chart? How many people have never seen that chart? You need that chart. That's your Bible. Okay? You can't write an offer without having that.
I have it on my computer.
This tells you who customarily, by county in the state of California, who customarily pays for escrow, who customarily pays for owner's title insurance policy, who customarily pays the county transfer tax, and if applicable, who pays the city transfer tax. How much is the county transfer tax? How much? $1.10 per 1,000. So if we've got $1.5 million, our seller sells for $1.5 million. Someone who's never answered yet, get your calculator out and tell me how much is the county transfer tax. It's $1.10 per 1,000. How much is it?
$16.50.
You weren't supposed to answer.
Oh.
$15.50. Who customarily pays it? The seller. Okay, now, city transfer tax. In Alameda County, the cities with the city transfer tax are in the top. We're right on the top. We're the first county alphabetically in the state of California. Alameda's $12. Albany's $15. Berkeley is $15 for up to $1.5 million. $25 for 1.6, over 1.6. Emeryville, 12. Hayward, $8.50. Hayward used to be $4.50. Oakland's got a whole graduated thing. Piedmont's 13, San Leandro 11. Now, it says above there, split buyer seller, meaning it's customarily split 50-50. So let's assume this $1.5 million house is in Hayward. So how much does each side pay if it's in Hayward?
8.5 per thousand.
It's $850 a thousand, split 50-50.
6,375.
Okay, 6,375. Is that all of it or half of it?
Half of it.
Half of it. That's correct. So each side, buyer and seller, each pay $63.75. Now, remember with Hayward, you can't rely on the address to determine whether it's in the city of Hayward. A large portion of Hayward is unincorporated. It's not within the Hayward city limits and therefore is not subject to the city transfer tax. And there's a portion of Hayward that's about a one-wood from City Hall that's not in the city limits.
Isn't that amazing?
Yeah. Question?
Could we go back just a little bit? How'd you get the 1,550?
That's the county transfer tax of $1.10 per thousand.
Okay.
Steve, you wrote the wrong number, it's 1650.
To 1650?
Yes.
Yeah, 1650.
That's what I said.
Well, you should have corrected me.
No, I'm not gonna do that.
You should have corrected me. I thought I heard 1550.
No, I said 1650.
1650.
And then when you
You're right.
wrote 1550, I thought, oh.
No, you should have corrected me. I'm old, I can't hear.
That's good.
So I'm still old school, I still have my Thomas Brothers maps, and I pull out the map and I can see if it's green, it's in the city, if it's yellow, it's in the county.
The big one is Castro Valley.
All of Castro Valley,
Because they
some
have-
parts of San
They have
Leandro.
San Leandro addresses.
Yeah, and have San Leandro address.
Because of the post office
Yeah.
situation.
Yeah.
Is it 1650 or 16,500?
Do I have to get my calculator out?
No, it's 1,650.
So 1.2.
Okay.
1650. Remember, it's $1.10 per thousand, which means that goes away. So it's $1 million, so you go 1,500 times $1. Yeah. When you're doing transfer tax, you drop the last 3 zeros, so it's 1,500 times $1.10. The more you do it, you'll automatically know that.
That saved some money.
Yeah, that saved a few bucks, yeah. But here's the thing. I mean, this is a huge amount compared to this. And remember, you're adding that to the buyer's closing costs. That's a huge amount of money to add to your buyer's closing costs because depending on the price, all their other closing costs might not be any more than that.
And Steve, just so you know, some lenders will not disclose that.
Yeah, well, yeah, you're,
Like
well,
when
no,
they're
that, well,
when they're pre-closing.
right, yeah, well, that's the thing is,
So
you know,
then they get a surprise.
yeah,
Silly.
yeah, that's the other thing to remember is that if, you know, too many of us rely on lenders' good faith estimates. Well, the lender doesn't know what city, may not know what city your buyer's planning to buy in, may not know if there's a city transfer tax. That's why you should be doing, you know, I've taught the class how to do estimated buyer costs. You rely on the good faith estimate. You can even have the escrow officer create an estimated settlement statement. But someone's gotta know what city you're looking at and whether there's a city transfer tax. That can be a huge surprise to your buyer if they're relying on the lender's good faith estimate. Like surprise, surprise.
Pay attention where it's at.
I will, when I know I've got a first-time buyer tight on funds, you know, I'll tell them that once we go into contract, I'll prepare an estimate for you to show you what your closing costs are gonna be, so that there's no surprises. And I'll say, you give me your good faith estimate from the lender, I'll either get an estimated settlement statement from the escrow officer, or I already have plenty of them myself, I know what all the fees are. Once I've got the lenders, I can plug in all the other numbers. Remember, most of your title companies they have sites where you can go and do estimates of closing costs, calculate them right online. Put in, you can put Chicago Title Rate Calculator, and they'll pull up the site, and you can give it the location of the property, the purchase price, the loan amount, and it'll give you all the title and escrow fees.
That's a big benefit.
Yeah. All right, moving on. I'm gonna speed things up a little bit here because we spent a lot of time on property taxes. But I knew we would because of the demographics of the room here. Federal capital gains tax. So, the federal government has capital gains tax. You have what's called a short-term capital gain and long-term capital gain. Short-term capital gain is when you own the property for less than a year, and a short-term capital gain is taxed at normal income tax rates. Once you've owned it for a year, then you have a long-term capital gains rate, and it's going to, the rates are going to be, depending on the gain on the property, is going to run between 15 and 20%. Now it's a little complicated. What I've got here for you is I'm showing you the tax rates for this year and next year.
That's weird.
And here's where it gets complicated, but I'm going to go through, I'm going to give you a whole calculation. And we're going to assume we got a taxpayer married filing jointly, okay? For everything we discussed the rest of this class, we're going to assume the taxpayers are a married couple, okay? Now, the first $8,300, $350 of total taxable income has no tax to it. Now, this 15% tax rate applies to their taxable income, but you take out the capital gain portion, and that's taxed at normal income. The balance, and I'll show you in a chart here, I'll write it out here in a minute. The balance is subject to 15%. Now, if their total income is over $517,200, then there's a portion of that capital gain is going to be taxed at 20%. So all you need, I'm going to show you an example. All you need to know is you need to tell people that depending on your total income and capital gain, you're going to pay between 15 and 20% in taxes. That's all you need to know.
On the sale of your house.
On the sale of the house. Okay, federal. California does not have a capital gains tax. California taxes capital gains as ordinary income, meaning it's added to your other income, and then typically, depending on how much you make, will potentially jump you into a higher tax bracket depending upon the amount of gain.
Somebody that's owned their house for a long time,
That's what I'm going to show you. That's what I'm going to show you, because it comes up a lot now. But again, just so we're clear, I'm going to go into an in-depth thing here just so you can see just so to familiarize yourself what it looks like. I don't expect you to know it, to do it, or try to do it, okay? But I want to take you through it so you understand, appreciate what we're talking about. All you need to know is that they are depending on their income and the amount of the capital gain, they are going to pay between 15 and 20% in capital gains taxes on the sale of their house. And all we're talking about right now, folks, is principal residence. We're not dealing with rentals or anything like that. This is all principal residence, just the mom and pop sale houses, okay? Okay, so here's how, where's my cheat sheet at?
They changed the brackets a little, didn't they?
What's that?
I see for 2023, they changed the bracket income up to
Yeah.
553 as opposed to 517 for married.
Okay. Okay, we're gonna assume that, okay, we're gonna do, all right, I gotta stop using this one. It's weak. Okay, we're doing federal right now first, okay? So we're gonna assume the sales price of $1,500,000, okay? And given market conditions, and William's not here, but William made a good comment yesterday in the team meeting that with the slowdown in the market and the longer the properties are on the market and the longer we have to market properties, that is a good justification to list a property for 6% and not 5%. Okay? Just some food for thought. We're gonna be spending more time, money, and energy to get a home sold. That is justification for a 6% commission versus the old 5%. So let's assume that commission is 6%, and then the seller's gonna have some additional closing costs for proration of property taxes. Now remember, when we're figuring capital gains, the loan on the property has nothing to do with it. You will find people that think their capital gain is after the loan's paid off.
Yeah. Surprise.
Loan has nothing to do with it. People that refinanced and pulled cash out of their property, they end up with less and less equity in the property, but that property keeps going up in value. They still have huge capital gains. So remember, the loan has nothing to do with this calculation. So let's assume we have cost of sale, which is the commission and the closing costs, property taxes, because we got $90,000 in commission, and then, $80,000 in commission, right? I'm doing the math right? No, $90,000 in commission.
94.
On $1,500,000, it's 90, 6%. And then we've got additional 90,000, 10,000 for additional closing costs. I'm on the high side. Yeah, I'm on the high side, okay? Okay, so that gives us an adjusted sales price of $1,400,000. Okay? Now, we subtract from that what's called the basis. Now, in our example, we're going to assume that basis is what they originally paid for the property when they bought it. And we're going to assume, in our example, we're going to assume that's $50,000. Now, you got to tell people to keep their settlement statements, because it's not just the price they paid, it's actually all the one-time closing costs paid at the time of purchase get added to that 50. Every dollar you can add to basis reduces your taxes. Okay, so you want it, the whole idea is to build your basis up. So they take that estimated settlement statement, your CPA takes all the one-time closing costs and adds that to the purchase price. I'm just keeping the numbers simple. Now, what we add to basis, we adjust basis by adding, during the ownership of the home, we add what are called capital improvements. Those can be added to the basis to increase the basis. And by doing so, that reduces the taxes. What are examples of improvements that increase your basis? Flipping your truck and you're there, and there it is. Additions: bedroom, bathroom, deck, garage, porch, patio, lawn and grounds, exterior, insulation, systems. Capital improvements are improvements. They're not repairs. If you spend money to repair a pipe leak, that's not a capital improvement.
It's interesting that a new roof is the capital improvement.
But only once. Because it goes down to here. Any costs of any improvement that are no longer part of your home, for example, wall carpeting that you installed but later replaced, you can only do it. So carpeting you can only do once. Roof, once. Anything that no longer there because you replaced it, you can't include it. So you got a lot of one-time costs. In our example, we're going to assume that this homeowner didn't do a whole heck of a lot, spent $100,000. Now they could have remodeled the kitchen 20, 30 years ago and not spent a lot of money on the kitchen. But I'm just assuming for our example that so this is that's their adjusted basis, $150,000. Everybody with me so far?
No, the 100,000 capital improvement?
Yes, that's capital improvements.
I have a question.
So, go ahead.
People that sold and bought their current house years ago carried their gain into the new.
Yeah, you adjust your basis when you
reduced your basis.
Adjust your when you defer your every time you sell and under the old rule, your basis would get reduced.
How many people do you think take that into effect when they?
Probably not a lot. Well, it depends on how long they've been working with the same CPA.
What if the IRS actually?
I'm assuming that wasn't done. This is a long-term ownership, okay? Which is quite common. Everybody with me so far?
Yes.
Here's the thing, what you need to get your clients to understand, whether they're existing homeowners or new homeowners, they need to save receipts or cancel checks for all their capital improvements. My sister-in-law, I sold her house a couple years ago. She threw away boxes of receipts. I said, well, all you can do is try to think back how much you spent and write that number down in good faith on your tax return and cross your fingers you don't get audited. But the whole idea is to keep receipts. Remember, now banks will keep canceled checks back to a certain point. But yeah, so that's why it comes to a closing gift, and everything's soft, everything's all soft copies. But man, I'm like old school. It's like, hey, here's an organizer. They have organizers that here, save all your receipts. Save all this stuff because you're going to need it at some point in time. Because every dollar of improvement you have is going to save you taxes. The bigger this number is, the less you're going to pay in taxes. Make sense? So we got that. So we take our adjusted basis of $150,000, and the amount realized is $1,250,000. You with me so far? Now, the next thing on the outline talks about stepped-up basis. What does that mean? Stepped-up basis applies when the last of the parents, and I'm just simplifying this, the last of the parents passes and leaves the property to a child or children. On the date of death, the basis gets stepped up to the value at date of death. So let's just say mom and dad dies, they usually go first, then mom, the day mom dies, and we'll assume they held title as community property, it was community property, their basis was $150,000. If the property's worth $1.5 million, the day mom passes away, and it's left to a child or children, the children get what's called a stepped-up basis to the value of date of death, to the $1.5 million. Now, what's the benefit of that? The benefit of that means if the child turns around and sells the property, they're gonna sell it for a loss, not even for a gain, if they sell it right away. Now, if they hold on to it and it goes up, if it gets stepped up to $1.5 million, and then let's say they hold on to it and they sell it when it gets to $1.6 million, well, then they've got, even if you assume, they're almost at a break even anyway. If you take $100,000 of cost of sale off the $1.6 million, they're at about netting about $1.5 million anyway. They've got little or no capital gain. Yeah. See, that's why it's not smart for parents to give property to their children while they're alive.
Right.
You want them to inherit it. Because when we say early, now, the property tax issue is different now, because they only see, it used to be in the old days, property taxes, there was no reassessment of property taxes either. Well, now there's reassessment unless it's principal residence. So the taxes are gonna go up, but the capital gains consequence, depending on the age of the child, could be much greater. You know, it's gonna be greater than the potential. Now, if the child's you could take the position that if the child's going to live in a principal residence, it's not so bad, but this property, that if you give them a property, here's the thing, when there's a lifetime gift, the donee who receives the gift takes on the donor's basis. If the parent's basis is $150,000, and they give the property to their child while the parent's alive, the child's basis is now $150,000. The property's worth $1.5 million. Under current law, they can only if the child's married and they sell it at any point in time, if they live in it and then they sell it, they can only exclude $500,000. They've got almost $1 million subject to tax under current tax law. That's why you don't want parents giving property away to their children while they're alive. It was okay under the old Prop 19, because there was, in most cases, the children were already living in the house anyway. And it depends on the value of the property too. 500,000
exemption, right? Stepped up basis, can you then, so that their basis would be, I mean,
Well, you would still, if they can't use it until they live in it 24 out of 60 months.
Oh, okay, right.
See, they've got to move, see, if the child lives in a principal residence, they've got to live in it for 2 years, and then they can sell and take the
loss.
Yeah.
Capital gains
yeah.
loss.
Well, they could only use the gain if they hold it as an investment, not as a principal residence. Okay, we got a lot to cover, so Anna Rotolo has graciously brought lunch for us. I need you to get up, go to the bathroom, get your lunch, and be back in your seats at 12:15. Okay? Because we got a lot to cover.
Harshita had to go downstairs to get utensils because they didn't give us any serving things. So.
Okay, well, we'll wait. I'll keep going until she gets up here.
Okay, I should be back.
Okay, stay in your seats. We'll keep going until she gets up here. I thought it was ready to go. Okay. Jerry, wait, there's no utensils
Yeah, talk
yet.
for like 5 more
Yeah.
minutes.
Okay, now.
Yes, sir.
What's the AR in it? Is that the subject to?
AR, okay, this is adjusted basis, this is amount realized.
So that's subject to federal tax.
Unless they qualify for the Section 121 exclusion, which I'm gonna talk about next. We've talked about it already. Section 121 exclusion. If you're a single person and you have lived in, it's your principal residence, and you've lived in the property for 24 out of the last 60 months, doesn't have to be continuous 24 months, you just look back 60 months, and during that 60 months, did you live in that property as your principal residence for 24 of those 60 months? If you're a single person, you can exclude the first $250,000 of gain. No tax. If you're a married couple, you lived in the house 24 out of 60 months, you can exclude the first $500,000 of gain. What did we say earlier? All our example is going to be based on a married couple. Look back from close of escrow, count back 60 months. And during that time, did they live in that house as their principal residence for at least 24 months? Doesn't have to be continuous, but you add up at least 24. Most people have lived in it the whole 60 months. There's no calculation to do. They satisfy it automatically. Now they can, if they moved out of it, and if I go back 60 and they've only got 12 months, they can move back in, wait 12 months, now have 24 months, now sell, take the exclusion. Question?
If they're boyfriend and girlfriend and they're not married,
Then they have to be
they're both
married,
entitled.
filing jointly.
Do they both get the?
They can each take the
250?
they can each take the 250 out on individually. If they're on title 50-50, they're single, they each take the they each get 250.
Only one is on title. a
That's
sole
fine,
separate
that's
property.
fine. It's okay, only one spouse has to be on title, both spouses have to use it. You have ownership and use. You have to own 24 out of 60 and use as principal residence. Only one spouse has to be on title as an owner, but both spouses have to use it as principal residence.
Okay, and they can get the 500.
If they married, filing a joint return, yes. So, in our example here, they've lived in the house for years and years and years, they qualify for the exclusion, so the first 500,000 is excluded. That's the 121 exclusion, leaving the capital gain at $750,000. Okay? Now here's where it gets a little complicated, but I'm going to erase all this. So everyone got that? Go back to that chart. Now, in our example,
Thank you.
okay, in our example, the couple has adjusted gross income of $350,000. I'm putting that down because that's going to be used when we get to what's called Obamacare. They have taxable income of $250,000. If you're familiar with a tax return, the bottom of your 1040 on page 1 is adjusted gross income. So we're saying these taxpayers have adjusted gross income of $350,000. Taxable income is after you take your adjusted gross income and take all your deductions, your itemized deductions, and standard deductions, personal exemptions, all of that gives you your tax income. So I'm saying they have taxable income of $250,000, okay, for our example. Now, using that chart, I'm not gonna spend a lot of time going on the calculation. The first 83,350 is gonna be 0. Okay, the next portion of their taxable income is 166,650. Okay, that's 0. This and this equal that. Okay, there's no capital gains tax on their taxable income. That's normal income. Okay. So we tax the difference between 517,200 and 166,650 is 350,550. Again, that's basically we're taking their 166 taxable income out of that number, and then we're taking the difference between 517,200 and the balance, which gives us that. That's taxed at 15%. which is 52,582.50, and then the difference between 750 and 355.50 is 399,450. So that falls here, 20% tax rate, and that tax is 79,890. So the total of those two is 160,973. So that's how much they're paying in federal. Okay, $160,973. Okay, everyone got that? Okay. Leave that number there. I'm going to come back to that in a minute. Okay, now, go to our, we'll come back to reduced exclusion here in a minute. Where did I go with my? Where'd my, wait a minute here. Sorry about this. That's not it. Where did I put the state here? Wait a minute. Gotta find my. Oh, here we go. Yeah, here we go. That's what I want. Okay. Here's our state. This is the state taxes. So we've got their total. We said their gain was $750, right? And they've got taxable income. So this is so we're doing state. Their capital gain, which is tax-exempt income, was $750, correct? And then their other taxable income is $250. So they've got $1 million in taxable income. Now, so they fall into this bracket here. The $1 million falls between $750 and $1,250,000. So they're in what we call the 11.3% tax bracket. So their taxes is $65,046.38 plus 11.3% of the amount over $750,442, which is $28,205 for a total of $93,246.43. So again, this is state tax. So they're paying $160,000 federal, $93,246 in state. Okay? And this example. But we're not done yet, because when Obamacare was enacted, they put in an additional tax to help pay for the health care. And even though under the Trump administration they got rid of some portions of Obamacare and redid it and so forth, they never got rid of the tax. That tax is still there. So the tax is and what here's how they pitched it was the tax is only going to apply to the wealthy. That's what they said. Remember that? That's how they said, oh yeah, don't worry about this. It's only going to apply to the wealthy. Well, here's who it applies to. It applies to an individual with adjusted gross income above $200,000, and applies to couples filing a joint return with more than $250,000 in adjusted gross income. and the tax applies to the lesser of your invested income or the excess of adjusted gross over 200 or 250. So how does this calculate? So here's an example on the top. There's an example of how you do the calculation is here. For those of you that want to plug numbers in, but I'm going to give you the calculation here real quick. So we got this couple has AGI of 350,000. The gain on their sale is 1,250,000. They have taxable gain. So we take the 500 off the 1,250,000. They have taxable gain of 750,000. They have a new, what's called new adjusted gross income of 750 plus 350, which is $1,000,001. And their excess over AGI is 850,000, and their taxable gain is 750,000. So you take the lesser of excess over AGI or taxable gain. So you take the lesser of, which is this number. Okay, and then you apply 3.8%, and that amounts to $28,500. So their total tax, all in, is $173,136, which is an effective tax rate. Taking all three combined, is an effective tax rate of 23.1%.
They should take the money, go to the Bahamas.
Yeah. Okay, so I've shown you an example where you got federal, state, and you get hit with another 28 of Obamacare. So they're paying on a gain of $750,000. They're paying $173,136, and the effective rate combined is 23.1%. You learn something?
Yes.
That's what the CPAs do. But no, here's the thing. I'm just doing that just so you can see how it comes about. I get asked this a lot. I said, yeah, you're going to have federal and state, and you're going to have Obamacare. Well, what's that? I said, well, it's 3.8%, but it's too complicated for me to tell you verbally how it works because it's very complicated. But you can tell people, generally speaking, that you're probably going to be, you could be looking at taxes of anywhere from, say, 20 to 30%, 20 to 35, somewhere in that range, 20 to 30, 35% taxes when it's all said and done. I mean, if it's a big deal to them, if it's going to impact their decision to sell or not, send them to a CPA and let them do the calculation. The CPA can calculate it out for them and tell them right away what it's going to be. Because you got to remember, here's the other part of it. If they use all that net money to buy a house, where's that money going to come from next April? Right? So they've got to remember they're probably going to have, they need to know what this is. They're going to have to hold that money back because they can't spend it on another house, right?
Can't roll it in.
Yeah, so you got to, that's the other reason they got to know all this. All right, it's 12:20. Anna, you got a presentation?
Yeah, just give me a couple of seconds, okay? So, good afternoon, everybody. Good to see you. So, real quick, I'm now with Synergy One Lending. Now, let me explain to you what happened. The first week of October, we heard rumors that Finance of America was getting sold, and quickly my phone started exploding from recruiters. The company sort of said, oh yeah, there's a letter of intent. That was the first week of October. On October 23rd, that was the next time the company communicated to us, and we're owned by Blackstone, so we're owned by a huge equity fund, and we're thousands and thousands of employees across the nation. We're ranked in the top 10 across the country. And on October, it was 23rd, somewhere around there, the company said, oh, we've decided to close You have until the 25th to originate a loan, you have until the 31st to lock a loan, and then on November 1st, like, you guys are all gone. Like, we're like, like what? Like, I've been here 7 years, you know, I'm a top 1% originator in the world, and I'm just like, going, huh? Like, so, luckily I had started taking some of those calls from recruiters, and I have a team of 20 that I work with in my office, so there's a lot of livelihoods at stake, right? We talk to a lot of really, really great companies. I decided on Synergy One for a few reasons. They are a private firm. I really did decide I didn't want to be owned by an equity fund anymore, and I didn't want to be a public company anymore because there's different motivations when you're a public company. So they are a private firm. I actually know the CEO and the president really well. I've known one of them for over 15 years, the other for 9 years. And one of my friends who I've known since I was 21 years old, so just about 5 years or so. Hey, don't laugh so quick and loud. Like, he runs the big Roseville office. So I have a lot of comfort in the company. Really technology-driven company, which I really like. The consumer experience is really nice. I'll be sharing that with you guys at a future date, but we have something called S1 Connect, where the client is operating through that system at all times. And then we also have another technology called FinFit, F-I-N-Fit, wonderful for incubating our clients as they're preparing for home ownership or post-close for them to track their finances. It lets them do soft credit pulls, do what-ifs for themselves, things like that. My technology can be co-branded with you and there is no cost, so that's another great feature. The NMLS, in their super efficient ways, haven't approved my license yet. So, so I'm like going, okay. So I'm just casually waiting so that I could, you know, do business again. But I am still doing business because I have friends in the company who are running my loans for me. Thank you, Alex. And thank you to KW for making my very first business card. It's really big, but it works perfect, so you guys know how to reach me. My cell is always, always my cell, so please don't ever hesitate to reach out to me. I'm here to help your clients. I'm really excited about things. Rates have been good this week, so it's been super fun. People are saying, have we topped out at inflation? Maybe, we'll see. The feds, though, are still talking about that they're going to probably still do another bump, but we're seeing a slowing in the economy. So the rates are doing fine. Let's not get hung up on rates. Let's just get clients in homes and let me talk to them and guide them and everything. Enjoy lunch. There are vegetarian options as well as chicken options. I cannot stay. I'm actually moving my mom today and tomorrow. And so I swung up here really fast to just see you guys and say hi. Now I have to go deal with a hysterical 83-year-old and have a lot of fun with her. So, but don't hesitate to reach out to me. Let me know how I can help you. I will be coming back and sharing more about Synergy One with you. And I'm just here to help you in any way I can grow your business, close your buyers' clients, okay? Have a great day. Enjoy your lunch.
Try to be in your seats as close to 12:30 as possible.
So hurry.
Yeah.
That's about 6 minutes.
Oh my God, I know the month of November has been like, as I said, on Thanksgiving, I'll be like really thankful. I'll be sitting there like, oh thank God, I've gone through all this. But,
So I'll give you information.
yeah, perfect. And I will be sending you some stuff. I just can't do anything next week. And it's like the NMLS, because renewals are coming, of course. So right during renewals, it's kind of my mom's doing great. Medically, I got her all tickets, independent living. So not, so she doesn't need any assistance or anything, but I need her closer to me. Because, it was like in July, and all of a sudden, like, she had her teeth, her dentures had problems, like her big broke, her bridge broke. Then, yeah, so she's just like, and then, it was her knee that she was crying about, her pain, but it ended up being a bulging disc in her back. So I had to get her the shots and everything. So it was just like, she sort of fell apart for a couple months, but with me in Pleasanton and she's in Campbell, right around the corner from your house you sold. It was so hard, yeah, and my sister's come in the Gilroy, so, and then I just said, Mom, this is it, I got pretty close to me, because like, and plus she's all alone. So yeah.
Well, she's got a good
Aw, thank you.
Daughters are wonderful. I had eight children, and one of the daughters.
Yeah. Well, it cracks me up because my brother keeps going like, oh, come in and help. I'm like, okay, great. He arrives tonight, he arrives at the airport tonight at 6. And I'm like, going, how's that helping me? I don't get it. And the last time he flew in, he picked her up and brought her to my house. And I'm like, yeah, I'm going like, okay, well, I've been doing that every week. I don't get it. But yeah, it'll be nice, because she's only 6 miles from my house now. So I can just, it'll make it, and the thing is, like, it's been so, I know this is a weird word to use, but it's been so transactional with her lately, because it's just like, I gotta get her to a doctor appointment, I gotta get her, you know, versus just going and being able to just sit and talk to her, you know, because by the time you drive down there an hour, and then, you know, I'm like.
Arguing with them what they need to do.
Yeah.
You need to get a walker.
Oh, how are you guys? Good?
I'm doing good.
You look good.
I'm older than your mother.
Yeah. You're not as emotional as my mom. Hi. Oh, I'm so happy Jonathan got in.
The agent was like, oh, can we close sooner than sellers going through this? I'm like, well, if you chose our offer at the beginning, then it wouldn't have
Right.
the situation.
Yeah, exactly.
Oh, okay.
So we ordered the appraisal today, so the order went in and then the files, he uploaded all his docs yesterday and everything.
Great.
So-
Oh yeah, he told me, he's like, I upload everything, so
Yeah.
what else do we need? I'm like, oh yeah, now we're waiting for appraisal and we're
Yeah.
waiting for this. I'm like, we're good. And he's like,
Aren't you working with Carl Medford?
Uh-huh.
And he does a lot of deals.
Yeah.
You gotta get your license, kid.
No kidding. I don't even have an office anymore. No, because they closed down the office, so we're like, and I'm literally reaching out to them going, what do I need to do to help you? Cause like, you know, I had like this 6,000 square foot office, fully furnished, and I'm like, what would you like me to do to help you? No response. So I was able to close my entire pipeline
Oh, yeah, yeah.
one that actually Kim Barnett has, so I called her with, clients and I said,
when we meet up.
because I have them at 5.5% Cali
No,
Showcase,
we're good.
and they're getting $45,000 in down payment assistance.
Whoa.
And I said, you
Sold
have
500
December
houses last year.
9th
That's
to
how
close
many
this deal.
sold.
And of course, the seller issue popped up, and I'm like, no.
So if you're not licensed, you can't see that.
Correct.
Oh,
Yeah.
well,
So
I hope
I
they're-
have the,
hope they're setting
so
it
Kim's
aside.
deal, I transitioned over to a transition loan officer at Finance of America. And as long as it closes by December 9th, they'll be fine. And I've been tracking it every time. And I had to leave that lady time because I said to her, I said, I can't make this deal with your rate. And I said, this is, yeah. And she's like, "What's the deal?" And I said, I'll try to track it as best I can, you know what I mean? So, but everything else I was able to close. I was like, can we close early? Can we close early? Yeah, and now the new ones, I'm just typing over what I've done. And then as soon as my license comes through, it should be hopefully any day. Then we were talking about it being that's like why I've been stalling on the other jobs.
Yeah, yeah.
Because I'm like, oh, just a couple more days, like.
He's like, I haven't heard back. Oh yeah, I saw the email. He's like, she's transitioning, she can't share anything yet. Oh, okay.
Yeah, I mean, it's like, if I say a quote, a rate, then I'm breaking the law, you know what I mean? I'm like, oh.
Are you or, Ren or the other,
Joel.
yeah, are you able to share like the estimated like closing costs?
He'll get that, he actually got that too.
Oh, Jonathan got it?
Uh-huh.
Oh, okay,
Yeah.
because he was asking me, and I'm like, okay, I'll ask you, and I'm actually.
Yeah, we sent that to him today. So. He'll get it off. I actually, so through Synergy, I have a jumbo that just went into box, and it's only been there, so I've been there for a week, and I sent it in a couple of days earlier than I got there. So it was out, docs were out in less than 2 days. I was just like, sweet, that's why when you said you could close early, I'm like, yeah, probably, but I
I
still
know
have
after you guys,
holidays.
you guys got learning to do.
Great card.
I know John will work pretty quickly though, so.
Yeah.
So we'll see. And his
Is
mom,
it?
dude, his parents are so sweet. Glad you got that. Yeah, his mom's like, Because they're literally.
Serendipity sometimes.
Yeah, I got all his mom's info yesterday, because I said, oh, by the way, is your mom working on this? Let me ask, hold on. Okay. Let's throw more people on the loan.
Yeah. Oh, so she has to be on the road.
She doesn't have to be, she
Okay.
wants to be.
Oh, okay.
So I was just like, okay, so I didn't have any of her info, so I just added her info in,
Okay.
so.
I think they just, that way she can have more control of if they need more, or if he needs more, then they'll have it.
Ah, perfect. Good.
Good to see you too.
It's nice if you have more than one, so that's easy.
Yeah. When we got from the shelter and
Oh, yeah.
2 weeks.
That's where I was, oh, that's nice, the way the transition is going. Do you think he would? Oh, I know. It's just so sensitive. I was just like, I mean, in like 39 years, that's never happened. I mean, I had to document the house, the notification, I think it's because they were.
The whole house.
No one will figure it out. Like, we were getting all every day. So recruiters were telling us every day on this day. I'm like, we are? Yeah, that's what we're hearing from. And I can't even believe how this week, like, but what's the, I heard something that was from the movie. So I was something like, they come back. So, but I'm gonna be really happy when Thanksgiving. Okay, I should probably go take care of my mom.
So take care of mama.
Go take care of mama. See what she's doing, she keeps changing her mind on what she wants to bring. I'm like, I can't bring that.
You don't get options.
Take
Yeah.
her every day.
No, we're not bringing that.
थोड़ी थोड़ी देर में आगे तो भी ना लेकिन देखो तो वैसी गर्मी रहती है ना अपना जाके आदमी नहीं रहेगा now it's free right one is like a hunter everywhere मतलब फिर कॉलर में एयरटैग लगाना पड़ा अच्छा to figure out where he goes because एक तो बार he didn't come back at night एयरटैग on the collar
Yeah, some person hasn't enough.
दूसरा जो है सामने बैठा है कभी कभी कंफर्ट तीसरी जो है वो बाहर जाएगा she was in my दरवाजा
And I want my sewing machine. In my china closet. I'm like, no.
you just stay there I'm not gonna go anywhere
Well, I have got
they are two years old this one is maybe that's 5 years old so you can put that over so he can come inside to shelter में somebody
my famous man.
I got her when she was 8 years old.
Oh, at this time. Leadership consumer and money. Then he says, I mean,
Yeah, ma'am, बचपन से हम तीन बच्चे but I got it
Oh my God.
and then I got the two Akitos and then
Oh my God. That's funny.
चलो मेरे साथ I give you the whole thing.
In like 8 years.
I do little bit minutes for the her hafta I just throw it away and I get it in new box.
I know.
Well,
Actually, right here, just as it's Stanley and there's a senior apartment. And they also have a dining room.
I got automatic filters like
Hair salon and
funny of
and then there's down the line.
और इंडिया में रोज एरिया कुछ नहीं होता राइट तो खाना
Okay, I have to apologize. I don't know what was going on yesterday afternoon when I was preparing these numbers, but I added up the taxes incorrectly. The actual total taxes, $282,719. You guys aren't on the ball. I mean, you're not even looking at the numbers here. $282,719, effective rate 37.7%.
That's only federal.
That's all.
That's
All
all.
taxes
State.
combined. So there's 282,7, yeah, I don't know how I even came up with that other number yesterday. 282,719, 37.7% is the effective rate.
yep. A lot of money.
All right, one thing we skipped over earlier on the Section 121 exclusion, you can have a situation where someone buys a house and then they don't have an opportunity to live in it for 24 months because of unforeseen because of either a change in place, a change in employment, health reasons, or an unforeseen circumstance. Change in employment means they have a job transfer and they have to move more than 50 miles away from where they currently work. Health reasons could be another reason, or unforeseen circumstance, and that could be a change in employment where your pay is reduced and you can't reasonably cover your basic living expenses. And if you qualify under the requirements for the reduced maximum, you can prorate that 250 or the 500. So let's say you have to sell. Let's say you have to sell after you only live in the house for 12 months, and you fall under one of these qualifying circumstances. And you're married finally jointly, you could still exclude 250,000, half of the 500. So that's what reduced maximum exclusion is all about. Okay, any questions about anything we've done so far? Okay, the next thing we're going to talk about is tax withholding. And I'm going to go through it kind of quickly for the sake of time. Under federal law, if the price of a property is less than $300,000, 300,000 or less,
Where's that?
and it's going to be used as a principal residence, there's no federal withholding. Otherwise, you're looking at, if it's 300 to $1 million and the buyer's gonna use it as a residence, withholding's 10%. If it's over $1 million, the withholding's 15%. But that applies to a seller who is a non-resident alien. And then there's other factors that go into that, dealing with green cards, substantial presence, and so forth. So if you have someone who's not a U.S. citizen selling a property, you need to have them sit down with their CPA and figure out what their residency status is and whether or not they're going to be subject to federal withholding. California withholding doesn't apply to doesn't apply if the sales price is less than $100,000, if the property was used by the seller or the decedent as principal residence, or the last use by the seller or decedent as was principal residence, and qualifies under 121 regardless of the time frame. If you're selling at a loss, or if the seller's a corporation or a partnership, and that could be an LLC, and if it's an insurance company or a qualified pension profit sharing plan, IRA, or charitable remainder trust. So you have, this is what we call the AS affidavit of status. You should have your sellers, each one of your sellers should complete one of these when you take the listing. Basically, you want to establish that, you know, in most cases, if it's an individual, they're not a non-resident alien. If they happen to have a trust, and the trust falls under 3B. This doesn't list the exemptions. They'll see another affidavit entitled in the closing papers that will list all the exemptions, the ones that I just read to you. This says that they're not giving the seller their Social Security number on this form. They're going to give it to a qualified substitute who is the escrow officer. But yeah, you should have this completed by each one of your sellers when you take a listing.
It also makes you think about what they're gonna be paying in taxes.
What's that?
That brings out what they're gonna pay in taxes.
Yeah, right. Now, one thing to remember, keep in mind is you could have the California withholding rate is 3.33% of the purchase price. Where we typically see, you're typically going to see withholding with investment properties, rental properties, because it doesn't apply to principal residence. But anytime you got, rental property, investment property, now there's no withholding if you're going to do a 1031 exchange. Now what this talks about is if the seller's actual taxes are going to be less than 3.33% of the purchase price, then you can complete a 593E withholding affidavit where you actually calculate your gain or loss from the property, and then the escrow officer can rely on that number and only withhold that amount if it's less than 3.33%. And I've had that situation with multiple people where 3.33% is much greater than the actual taxes that they're going to pay on the property. So they can have that withholding reduced by that amount. So just keep that in mind when you've got a seller who hasn't owned the property for a long period of time. If they haven't owned it a long period of time, they may not have a huge tax liability in California. And
they don't get the 500,000 or 250 exclusion in California.
Oh yeah, it applies. Yeah.
Okay, well
yeah,
then, if they've had that very long, they may not even have any tax.
No, yeah. Okay. Moving forward here. So next thing we're going to talk about is 1031 exchanges. Now, Jerry, I'm talking about people that it's a rental property that they haven't owned for very long. I'm not talking about principal residence because there's no withholding anyway. I'm talking about people subject to withholding with low, yeah. Where, a common area where you'll see tax withholding is parents have a trust, they leave property to your kids and as beneficiaries of the trust, but the property's still in the trust. If the child sells the property as the trustee of the trust, there's no withholding. But if the child takes the next step, deeds the property to themselves as an individual, they transfer themselves as trustee to themselves as an individual, which the trust says you're to do, now they own it as an individual, and if they sell it and they're not doing a 1031 exchange and they're not selling a loss, they're going to be subject to tax withholding. Okay, 1031 exchanges. This is kind of like as complete of a synopsis of 1031 exchanges that I've been able to create without going well over into detail. Remember that, okay, 1031 exchanges, we're talking of 1031 exchange defers capital gains taxes, does not avoid capital gains tax. Okay, always be careful. You always got to say it. You want to defer, not avoid. The only way you avoid capital gains tax is you die. You never sell the property. You leave it to your kids, and your kids get that stepped up basis. All that, if you leave it to your kids, all that gain that you otherwise would have realized if you sold it goes away. You know, like in our scenario, it goes away. Because their basis is the value of date of death. If it's worth $1.5 million and they turn around and sell it for $1.5 million, no gain. If they gave it to them while it was alive, their base was $150,000. They never lived in the house. They got a gain of $1,350,000. A lot of money.
Can they still get stepped up basis on rental property?
Everything gets stepped up basis.
Okay.
Under current law, the Congress talked about modifying stepped up basis, but they didn't. Thank God they didn't. Okay, so the 1031 exchange applies to a business or investment property, not your personal residence at the time of sale. If the property was a principal residence when it was sold, it doesn't qualify for a 1031 exchange. It has to be a business or investment property, rental property. Now, there's no time limit for converting from principal residence to an investment, but you should hold it at least, according to my CPA, you should hold it for at least 2 years and file tax returns showing the new residence and the property as a rental. So my CPA says if you want to convert it to an investment property, you need to hold it for at least 2 years. There are some out there that will say a year or more is enough. Depends on how aggressive the tax preparer is. Always have your client talk to their CPA and get their opinion as to how long. If they want to move out of it and make it a rental, how long do they need to make it a rental before they can do a 1031 exchange? As like kind now means any type of real estate. It used to be it had to be the same thing. If you sold vacant land, you had to buy vacant land. That's not the case anymore. It's any type of real estate. Remember, there are other options to buying standard real estate. One is a Delaware statutory trust. In a Delaware statutory trust, you own a small percentage of a big building, like a big apartment building, say a 500-unit apartment building. That Delaware statutory trust owns that whole building, and you buy a small percentage. You can do an exchange into that statutory trust, and then every month you just get a check in the mail. I have a client that did that. She didn't want to own a rental anymore, sold a condo, $800,000 condo in San Diego. She owns one small percentage of a huge apartment building in Denver, Colorado. And every month she gets a check for about 5%. It's about a 5% return. Comes in every month. Doesn't have to deal with managing the property. Charitable remainder trust is another option. That's really for people that are really well off and don't need the money. They can afford to set up, give $500,000 to this trust. They don't, they're setting it up and that can be done to defer capital gains as well. The exchange can be simultaneous, meaning both properties close at the same time, or delayed. Most are delayed. You don't see simultaneous exchanges too often. The seller and the buyer must be the same. Whoever's the owner, whoever's the seller has to be the buyer. Now, a single member, if let's say you have a seller and then they want to buy something and they want to set up an LLC, if they're a single member LLC, that's okay. If they're selling as an individual and buying a new one and setting up a single member LLC, that's acceptable. Otherwise, got to have the same seller, same buyer, same taxpayers on both properties. In order to defer tax, you've got to buy a property that's equal or greater in value. Okay? If you pay, if the price is less, then you're going to pay tax, capital gains tax on the difference between the price of the property you sold and the price of the property you buy. But you have to at least purchase an amount equal to the basis in the property. So in other words, if this property was an investment property, but it's not there, the basis was $150,000, you'd have to do an exchange and do it for at least $150,000, the basis.
Can the single seller LLC then take title to the new?
Ultimately, yeah, when it closes. Yeah, they take title when it closes, yeah. The exchange company is advised how they're gonna take title.
That's to use an exchange company.
Yeah, there's no way you can do it without using an accommodator. You have to use accommodator.
Especially a delay.
Yeah.
Because you closed escrow, you
Yeah.
can't touch the funds.
Right, you can't receive, the accommodator has to receive the funds. I was gonna say something earlier, now I just lost it here. No, you didn't, no, it was before that. It'll come to me. So remember, you gotta buy equal or greater in value. I know I was gonna tell you. When it comes to how the money is used, what you're spending is the net equity, the net funds from the sale, all have to go in, and you have to borrow the same amount of money as you currently owe on the property you sold. So you start with that premise. Your net funds and a loan equal to or greater than the current loan on the property. That's what I say, net equity and equal or greater loan amount. However, you can add cash and buy the loan down and borrow less, but you cannot take cash out and borrow more. So that's a lot of times where people get tripped up is they don't realize that they've got to borrow. They think all they got to do is take the net cash and buy something. No, you've got to borrow money too. The only way you can borrow less is you've got to replace that loan amount with more cash.
And you can refinance afterwards.
Yeah.
And take money out.
Yeah, you've got other options there. Yeah. But for purposes of doing the transaction, you've got to borrow, the same or more money.
So on that borrowing, would the interest rate would be the same as you borrow
Same as what?
as the previous loan?
No, it's a whole new loan. No, we don't have, that's funny you mentioned that, because we had, there was a time when they were talking about making loans transferable. There was talk about, trying to do that where you could sell and buy and and transfer the same existing loan and rate to the new property, but it never caught on.
Yeah, I can know that.
Now, it can involve more than one property on either side. In other words, you could sell one and buy two, you could sell two and buy one. It's still a matter of net equity adding up net equity, adding up loan amounts, and making sure that it's equal or greater on the other end.
So sell, detached and buy duplex?
Yep. Any type of property, doesn't matter. Like kind doesn't mean anything anymore. Any type of real property. You must use an accommodator, which is we call an exchange company. Most of your title companies have their own exchange companies. I use a company called Starker Services. They're one of the oldest exchange companies around. They've been around for years and years and years. They're actually the ones who came up with and went to the Supreme Court and got what's called the reverse exchange approved with Starker Services. When you're writing an offer on behalf of a client who's going to do an exchange, be it the seller or the buyer, you need to make sure that you include the appropriate intent to exchange addendum. And it's listed on the top of page 4 of your RPA. It shows those two. So if the seller intends to exchange, this has to be part of the contract. If you get an offer, you got to counter it and include that. This is required by the IRS. If you don't have one, the exchange companies go, we need an intent to exchange addendum. You're going to have to generate it. And then you have the same thing for the buyer. If you're writing an offer for a buyer, then you would be generating that as part of your offer. And then it has provisions for what happened. Is there going to be is there going to close without extension of time? Is there going to be there's an option for there to be an extension of the close up to a maximum number of days, or if it doesn't close on time, is it going to be canceled? It gives you different options dealing with the possible failure of the exchange. Yeah.
Do you know how it came to be the 45 days to identify?
When they were creating this, that's the dates they came up with. Don't know, never looked at the legislative history of that.
I think now that it takes longer to sell a property, you want to think this through ahead of time.
Oh, yeah. No, you've got, well, taking longer to sell doesn't hurt you because your identification period
Right,
doesn't
but you
start.
start looking.
Doesn't start until you close. So you get more time to look.
That's what I'm saying.
And you can enter into a contract before you can enter into a contract to buy before you even sell. It's just contingent on the sale. So you can actually identify your property before you even sell the relinquished property. And remember, if you close on your replacement property during the 45 days, there's no identification required either.
Could end up with a simultaneous close.
Yeah, but even like I said, even could be within that 45-day period. There's no identification because you've sold it. Any cash received equals boot. It's called boot and it's taxable. So if you withhold any cash, then you're gonna pay capital gains tax and ordinary income. We're gonna do those calculations on that money. But the whole idea of an exchange is to defer tax, not pay any tax. The seller carryback may be considered boot, so consult a tax expert. It's a little complicated. I don't want to spend time on that. So you need to have that examined. Now with the delayed exchange, you have to identify in 45 days after close of the relinquished property in writing the accommodator. There's 3 choices here. Now, when you set up, what happens is when you set up as soon as you go into escrow with the first sale, you submit the contract to the exchange company. They set up the exchange. And then paperwork is going to be created at close wherein the exchange company is actually going to be the seller of the property, not your seller. And the exchange company is going to hold the proceeds and then use those to close the next property that you buy. Okay. Now, you've got 3 different rules. You can identify 3 properties of any value, or there's a 200% rule. You can you can identify any number of properties as long as the total value does not exceed 200% of the relinquished property. So if you're selling, let's just say that was a rental property at $1.5 million, 200% rule says you could identify any number of properties up to 3 million. And then there's what's called the 95% rule. You can identify more than 3 properties with a total value exceeding 200%, but you got to acquire 95% of the value of all the properties identified. So that's a third one. The one that's most most people that I work with typically, if you're selling one property and buying another property for about the same price or within the same price point, most people are just doing the first one, the 3 properties. And remember, you can identify 3, and then if say you lose out on all 3, you can turn around and keep identifying new properties all the way until you get to day 45. Once you get to day 45, you're stuck with that list. There's no extensions. The other thing to remember, as soon as you agree to do a delayed exchange, if you change your mind, your cash is going to be held by the accommodator for 45 days. Can't get to it. And once you go through the 45-day period, let's say you list some properties in the 45-day period, and now you're moving it towards into the 180-day period to close. If you fail on all those identified properties, you don't get your money until after the 180 days has passed. Those are IRS rules. The accommodator has to keep that money for that period of time. So make sure your client is serious about wanting to do this when you start, because once you start, their money is going to get tied up for at least 45 days. You got to close on the replacement with 180 days after close of the relinquished property unless 13C applies. So the rule is you must close the earlier of the due date for the return, including extensions for the year the relinquished property was transferred or 180 days. What that means is if you close escrow between October 15th and December 31st, you got to close by April 15th. You don't get 180 days because the tax return due date is earlier. But you can file an extension, and then you just have to file an extension, and you're okay.
Steve, I have a question. Identify more than 3 properties. That means be in contract. What's identify?
I'm sorry, say it again?
What does the identify means?
Identify is the exchange company gives you a piece of paper, a document, and on it you write down the addresses of the properties that you want to pursue to buy. And you give that to and you send it to the exchange company, and they hold it. It's a separate piece. It has nothing to do with the contract. This has to do with the exchange company. You've sold the property. You've set up an exchange with an exchange company. Once you identify your properties, they give you a form. You write down the address. Here's my 3 addresses: 123 Main Street, 456 First Street, and you give that to the accommodator, and then they hold the document. And then you've got to close on 1 or more of those properties depending on how much you're spending. But if during those 45 days, 1 or more of those properties sells and you're not able to buy it, you can give them you can replace those addresses with new addresses. But you just have to know that by whatever they're holding on to on day 45, that's your last list. So you can see, like Jerry alluded, you need to start looking for a replacement property. As soon as you decide to put a seller's property on the market, you need to start looking for a replacement property immediately, and make contingent offers. I had a cousin that I sold. He was one of 4. Sold parents' house in Niles. He netted about $350,000 from the sale. He was going to buy a house in Phoenix, and he was at 25% off, so he was able to do a 10-to-1 exchange out to his 25% interest. And he goes down to Phoenix. Well, he got $350 cash. He figures, oh, this is going to be a piece of cake. It wasn't. The market was red hot. Man, he was getting beat out left and right. Man, he was really sweating it because I don't know if I'll be able to find a property. Man, I can keep getting beaten out. He finally had to kind of settle for a less desirable neighborhood, but he finally did manage to get the deal closed. 14, conversion of principal residence. to qualify for the 250 or 500 exclusion, here's what this is talking about. You've got an investment property, and you want to be able to use the 250, 500 exclusion. Well, that means you got to move into the house. So to qualify to convert a rental property to principal residence to get that exclusion, you have to, if the property was acquired through a 1031, you've got to use it for 2 years and own it for 5 years. Otherwise, you can convert, if you have a property you just bought outright as a rental, you can move out of your existing principal residence, move into that rental for and live in it for 2 years. Say it's a married couple, you could take the 500 exclusion because you satisfy the test. But what 14 is saying, if that property that rental that you're moving into, you acquired through a 1031, you can't sell in 2 years. You've got to use it for 2 and you got to own it for 5. Basically, they cut off that loophole because that's what people were doing when this exclusion first came to be. All these people sitting on all these rental properties go, this is great because I'll sell my principal residence and take 500 exclusion. I'll move into this rental for 2 years, sell it, take the exclusion, and prices were so low they're paying no gain on the sale. They were just domino effect, just going one rental after another. Well, after a few years of that, Congress said, no, we got to stop this. Now you've got to own it for 5 years. Then you have what's called a reverse exchange. That's where you buy a property first and then sell it. And there's a way that you can do a reverse exchange. It is allowed. Any questions? Okay. Like I said, this market conditions right now are such that you probably would find sellers willing to entertain a contingent offer. If you're making a decent offer on their property, you got a better shot now than you did a year ago. Okay, number 6, IRS Revenue Procedure 2005-14. This is the fun one. This is where you get to combine the Section 121 exclusion and Section 1031. This is the other thing I told you about internalizing Prop 19. This is the other thing you need to internalize. This is huge because the average person does not know about this. And what this means is, first of all, the key element of this is the homeowner needs to be able to afford to buy the replacement property without selling their house. And for a lot of people, they can't do that. But if you have a homeowner who can afford to buy their replacement property, or let's say their retirement home, without selling the house they currently live in, and they're going to have a huge capital gains tax on the sale of the house they're currently living in, they can combine 121 and Section 1031. So what happens is they buy a replacement property, they move out, and they rent their current principal residence. They rent it out. Now, as I said earlier, if they bought the replacement property in California, then if you want to transfer the assessed value for property tax purposes, you've got to close within 2 years. Well, in order to do a 1031 exchange, according to my CPA, you've got to rent it out for 2 years. So what happens is if you buy a house, a retirement home, you move out, you rent your house, and you buy a house in California, you rent your house out for exactly 2 years, you sell it, and you close escrow on exactly the date. So in our example earlier, escrow closed today, you would close escrow on your existing principal residence on November 15th, 2024. That meets the 2-year requirement to transfer your assessed value. It meets the 2-year requirement for the 1031 exchange. Because it's been a rental for 2 years, you can do a 1031 exchange, just like we talked about, and buy another investment property, an income-producing property. But because you've lived in it, 24 out of the last 60 months, actually lived in it 24 out of the last 48 months, married couple, you can take 500 exclusion as well. So at the end of the 2 years, you do a 1031 exchange into an income producing property, you pocket $500,000 cash, tax-free. The remaining funds and any loan is used to buy an income producing property through a 1031 exchange. And that property then generates income for you going forward. Make sense?
Yes.
This is huge. This has been around since 2005. It still doesn't get a lot of press. My CPA didn't even know about it. I was a little, and a lot of people don't. This is another one that I get buyer and seller leads through this and open houses constantly. Now, I'm not getting the listing. I'm setting myself up for listings 2 years from now, but I'm getting a buyer today. I've got numbers of people that I have lined up in my pipeline for this exact scenario. Because the first requisite is they gotta have enough money to buy something without selling their house, and a lot of people do. And you got people, I mean, I got a guy that lives in Avalon. I mean, his house is worth over $3 million. He bought it brand new for less than $1 million. Even the 500 exclusion is he's gonna have horrendous taxes. He thinks I walk on water now that I explained to him how he can save all that money in taxes, because he's got enough money to go afford to buy a house. He just has to figure out where he wants to live. So this is another one. You need to understand this, internalize this, because it's huge when it comes to saving on capital gains taxes. Any questions on that? You can talk to your own CPA and tell them Revenue Procedure 2005-14. And that's what it allows you to combine the exclusion and a 1031 exchange. Okay, income taxes. Pretty self-explanatory. You got federal income tax, you got state income tax. We've got different tax brackets depending on how much money you make. We don't really need to go into that right now. These are just examples of the tax tables showing what the different tax brackets are. Tax deductions. Obviously, the big deduction for us is mortgage interest. However, it's limited. Taxpayer can deduct interest up to a loan amount of $750,000. It used to be unlimited. Then it was $1 million on a first and $100 on a second. Now it's $750,000 is the maximum interest you can deduct on a principal residence. Property taxes used to be unlimited. Now you have a limit. It's called, if you ever heard of a SALT deduction, S-A-L-T. SALT deduction is a combination of property taxes and state income tax. The maximum deduction is $10,000. So we lost some of the tax benefit with the SALT limitation. There's been talk of, I saw a proposal to raise that to $80,000, but it didn't go through. There's actually a bill in Congress right now that was introduced last month to increase the Section 121 exclusion from $250,000, $500,000 to $500,000 and $1 million. Leon Panetta is the one who, local from San Jose, who introduced that bill. That's one I've been closely watching. I haven't seen any press on it, but that'll be big. Jump from a married couple who get $1 million exclusion versus $500,000. So even in my scenario where you convert the property, when you sell, you could pocket $1 million and just invest the balance of the proceeds and borrow, on the income producing property.
So the SALT deduction is what?
$10,000.
Yeah, property tax and?
it's a common, yeah, that's total for property tax and state income tax. Most people's property tax are gonna be well over $10,000. Even one of them is gonna be more than that. So it's a huge limitation. Withholding exemptions, what I'm talking about there is, you know, every year, if you're an employee, you're supposed to complete a W-4 to determine how much tax to be withheld from your paycheck. When you got a first-time buyer who's been renting, they're probably claiming like 0 or 1 exemptions. Have them sit down and fill out the W-4. Figure out how many exemptions they're gonna be based on buying a house and calculating the interest and the interest and property tax deduction, income tax deduction. Calculate how many exemptions they're qualified for. They might be qualified for 5, 6, 7, 8, 9, depending on the price of the property. And have them go to payroll or HR and say, I'm thinking about buying a house. How much take-home pay am I going to get if you change my exemptions from 0 or 1 to 5 or 6? Because what's going to happen, by increasing their exemptions, there'll be less tax withheld because they're going to save taxes because of their tax deductions. So therefore, they take home more money. That additional take-home pay will help them afford the monthly payment. Most lenders won't even talk about that. So whenever you have a first-time buyer, make sure, tell them, you know, especially like it gets towards the end of the year, you know, fill out this W-4, you know, give them numbers. Then go to a lender, they get pre-approved and say, all right, you're good to this purchase price and this loan amount, and here's the interest rate, and here's the property taxes. Take those numbers and fill out the W-4, assuming they bought that house, and plug those numbers into this W-4. And that's going to give them a higher withholding than what they currently have. And then go to payroll or HR and say, what's my take-home pay with this? Okay, number 9, net investment income tax. We've already addressed that. That's the Obamacare. We went through that calculation. So we are on the section 10, which is a new section that I added to this class because I knew there was a lot of new agents. So weird. So now we're segueing away from the sale of real estate to your income as a real estate agent. Okay? How many people have not filed a tax return as a real estate agent? Only one of you? Okay. How many people are not using a CPA? Everybody using a CPA? Okay. Yeah. I would not attempt to do my taxes. I did them myself for a while, but I don't I've had a CPA for many years. So remember, as a real estate salesperson, you now are as an individual, you're a sole proprietor. You own a business. You are a real estate business, and you report your income and expenses on Schedule C. This should be familiar to all of you. So this shows your gross receipts, your income, your gross profit, and then this is where you itemize your expenses for advertising, contract expenses, contract labor, depreciation, employee benefit, insurance, interest, mortgage, legal professional services. That can be your CPA fee, office expense, pension, profit sharing plans, rent or lease. Not all these apply to a sole proprietor. Repairs, tax and license, travel and meals, utilities, wages. And then there on the second page, there's a place to put other expenses. The big one that you should be aware of is your car expenses. And for car expenses, you need to keep track of your mileage. And you've got to separate your business miles from your personal miles. So you've got to keep a log, either a handwritten log every day of your mileage for the day and what you your driving that was done for business versus personal. Now, because you need to come up with what's called a business percentage because all your expenses, all the expenses that you have for your car, total expenses for your car, you can include here, whatever the total expenses for your car are, you can include that total, the business percentage of that total here. So you have to come up with a business percentage. Now there's a program, if you've noticed in CAR, there's a program called Hurdler. Hurdler will automatically track your mileage, and gives you a way to keep track of your business miles. Now there's two ways that you can state your expenses. You can keep track of your actual expenses, like I said, and apply the business percentage to that number, or you can take what's called a standard mileage rate, just based on the number of miles you've driven. And as of July 2022, the standard mileage rate was 62.5 cents. So you compare the two. Now remember, when it comes to automobile, of course, it comes to the purchase or lease of an automobile. If you lease an automobile, then the business percentage of the lease payment is an expense. But if you purchase an automobile, the only portion of that monthly payment that is deductible is the business percentage of the interest on the loan. So when you buy a vehicle, the acquisition cost deduction is much less versus a lease. But if you buy the vehicle, you get to take depreciation of the vehicle. And there are different types of depreciation, bonus depreciation available. Right now, there is a luxury automobile depreciation, which has a significantly higher deduction available, especially during the first 2 or 3 years. And that's why you see a lot of people buying these big luxury vehicles, because of the write-off that comes with it. There's a much bigger depreciation deduction. The second year is enormous. It's like, first year is about, max is like $9,000. The second year goes up to like $16,000, but it's the business percentage of that. So the higher the business percentage, the higher the deduction is. So that's something to keep in mind when you're going to get a vehicle for business. I've leased and bought. I've done both. Leasing, it really depends on the vehicle you buy. You've got to research residual values to see how well the vehicle is going to hold its value. On the last lease I did, it was a Lexus. It held its value extremely high, and when the lease was up, I was able to buy that vehicle for far less than what it was worth, because it had such a high residual value. It worked out. Okay. Plus, when you're buying the vehicle you already own, you know the vehicle. You know whether it's a known quantity when you're buying the vehicle you've already been driving. Okay, let's go back up to the outline. So, estimated taxes. Actually, I'm gonna see. I'll go back to my outline because you guys like to look up at the screen. So. Oh wait, it's not up there. I'm sorry. I just realized it's not up there. Okay, it's back to the outline. 10B, estimated taxes.
What's the $6,000 pound tax deduction for vehicles?
The what?
Isn't there a $6,000 pound?
6,000 pounds.
Yeah, 6,000 pounds.
Yeah, the luxury vehicle. Yeah, it's got to have a gross vehicle weight rating of 6,000 pounds or more.
So it can be with how much it can carry, right? are
Yeah,
most of the way
right,
by
yeah.
truck,
You
then
include, and you gotta include your passengers and the weight of the passengers and everything, yeah.
plus the 6,000 over,
Yeah.
including it, okay, got
Yeah.
it. And that's only once a year?
What's that?
That's only once a year?
The vehicle just has to qualify for when you
No,
acquire.
I mean to the deduction on that. so-
Depreciation?
Yeah, depreciation.
No, it's a it's over like, I think it's like a 5-year schedule, I think. It's a multiple year schedule. I think it's like 5 years on the luxury vehicle, if my memory serves me right. And it's really weighed heavy on the first couple of years. That's why it's a bit, you know, if you have a high business percentage, it's very advantageous. You get a big write-off. Estimated taxes, because you know, you're paid a straight commission, we don't withhold any taxes. You've got to, you're supposed to pay quarterly estimated taxes. So in order to do that, you have to, you know, when you're starting out, you gotta estimate how much income am I gonna make, what are my expenses gonna be, and what's my profit gonna be. And then I'm giving you a simple analysis. There's a worksheet you gotta do, but basically, you're supposed to estimate what your taxes are gonna be based on how much money you think how much profit you're gonna have, and then you make quarterly payments to the IRS, the Franchise Tax Board, on April 15th, June 15th, September 15th, and January 1. And if you don't pay that, then you pay taxes and penalties. It's not depending on how much money you make, it's not a huge amount of money, but if you can stay ahead of it, you know, then you're not gonna pay the penalty or the interest on that money. Self-employment tax, that's basically your Social Security and Medicare. That's 15.3. It's 15.3% up, 15.3% up to $147,000. Now, what's not on the outline is you can. You know, the other thing you want to consider is if your individual is, you know, setting up a SEP IRA, self-employed person IRA, and making it, you know, and funding an IRA. That's because that's a deduction. That's a above the line deduction, reduces your adjusted gross income. For 2022, you can deduct, and you can contribute up to $61,000, but no more than 25% of your compensation. So if you make enough money, you can put in basically 61,000 comes off of your income, so you don't pay taxes on that 61. With a SEP IRA, you will pay tax when you start withdrawing it at 72.5. We don't, because we're not employees, so we don't qualify for a Roth IRA. I was asked to remind you that, you know, at the end of the year, you know, by January 31st each year, if you have a transaction coordinator, you should be 1099ing your transaction coordinator for the amount of money you paid him or her during the year. Car expenses, we talked about that. I gave you a cheat sheet for office supplies and office expenses, just to kind of explain to you the difference between supplies. Basically are tangible items that you use in the office. Business expenses, there are other things like apps, website maintenance, web hosting fees, domain names, software, but then it also includes, you know, computers, laptops. Now, when you get into like computers and laptops, you know, there's typically you're going to have some. You're likely going to have some sort of depreciation taken for that equipment. Other expenses, some of the stuff that's I have broken out on mine are telecommunications, web page, internet, and software monthly service, although it could fall under office expense, professional dues and MLS fees, books, tapes, and publications, promotions and gifts, TC fees, escrow repairs and costs, and seminars. Those are some other expenses that I have on my return. S corporation is an alternative to filing as an individual. You can set up an S corporation, and some of the things you can do there is you can pay yourself a salary, and then the other portion of it be dividends. You'll only pay self-employment tax on the salary portion, not on the dividend portion. The dividends would be taxed as personal income. The S corporation does limit your liability to just the assets of the corporation and not your personal assets. I don't know that, given the E&O limits that we have, I don't know if that's a big deal, but it is another benefit of the S Corp. Most recently, there's now what's called the California Pass-Through Entity Tax, where you can pay California taxes to the corporation, get a 9.3 reduction in your federal taxable income. But on the flip side, there's costs to setting up an S Corp, you've got separate tax filings, and there's a 1.5% California corporation tax. So, and you've got to, depending on how much money you're making, you've got to compare one to the other to see what makes sense. A CPA could look at your situation and tell you whether one makes sense versus the other. And real quickly, some other tax strategies. Some of these I think are going to apply if you're at a point where you're making a pretty decent income and you're really trying to save on taxes. There's one called the Augusta Rule regarding Section 280A of the Internal Revenue Code, where you can basically rent your home to your business and use it to hold meetings up to 14 days a year. So what you do is you go figure out what's the cost for rent a hall for a meeting for a day, whatever that cost is. You could use that cost. They gave an example of $3,000, which seems kind of high, but you could use that rental rate, and you could set up up to 14 days a year. You could set up meetings in your house, and basically have your business rent the home, for that amount of money. You can even do it for a second home. If you have a second home that you don't rent out, you could do it. Say you got a cabin somewhere you don't rent it out, you could do another 14 days on the second home. Hiring your kids, pay your children as employees, would allow them. They could you could pay your kids to do stuff for you, and you could set up. They could take that income and set up a Roth IRA for up to $6,000 a year. And then they could, depending on their age and how much they accumulate, they could take that, put that IRA into what's called a self-directed IRA, and roll it and put it into an LLC, and then if the parents buying investment property, the LLC that has the kids' IRAs could buy a percentage of that property along with the parent. And then there's some benefits that come with if you make enough money that you qualify as a professional real estate investor. There's some benefits to that, particularly if you bought rental property after 2018. And then, let's see, that's pretty much it there is one thing about, if you've ever heard of opportunity zones, those are considered, they're census tracts. Typically people think of as less desirable areas, but they're not necessarily less desirable areas. If you buy investment property in an opportunity zone, there's a potential that you could sell that property after 10 years and pay no tax on the sale. It's in an opportunity zone. So that's something else to think about. Any questions? Did you learn anything?
Thank you.
Any questions? No questions? You're experts on it all? Okay. Very good. Well, thanks for being patient. We went a little over, but I hope it was worth it. If you have any, I said, CPA is a good person to have in your back pocket. Run questions by them.
One thing I want to just forgot to ask. So if you're living on the property, you rent it out